Charlton. It's March 22nd, 2023. I want to welcome everyone to the Board of Finance budget hearing. I'll call the meeting to order and ask that we please all rise for the Pledge of Allegiance. I pledge allegiance to the flag of the United States of America and to the republic which stands one nation, under God, indivisible, with liberty and justice for all. Okay, to the members of the public, this is our 5th budget hearing, and it's the last one where we'll be reviewing departmental budgets for fiscal 23-24. We had a tentative makeup session on the schedule for tomorrow night, which will not be needed and has been canceled. Our remaining budget schedule after tonight includes the public budget hearing this Saturday morning, March 25th, 9:30 a.m. at Fairfield Ludlow High School, and a final hearing on Monday, March 27th, to review and discuss any follow-up items requested by the board. Next Thursday, March 30th, we'll vote on the recommended budget to be sent to the RTM. Residents are encouraged to send comments and questions before or after the meetings to the following email, bof@fairfieldct.org. If you do, please remember to put your name and address in your email as you would with live public testimony. At each hearing, we also welcome live public comment that's pertinent to the night's agenda. For residents joining us through WebEx tonight and who are joining us through WebEx and wish to make a statement during the public comment session, please go ahead and drop your name in the chat box now. We ask that comments be limited to 2 minutes per person. Residents will also have an opportunity to provide live public comment on any aspect of the budget at the public budget hearing on Saturday. Okay, do we have anyone in the chat? Okay. All right. Okay, so no public comments, so we'll move on to item 4, discussion of departmental budgets. I'll make a motion to hear this item. Can I have a second? DeWitt. Okay, so we are going to start with the retiree section. So this is Department 1310. We're going to start with OPEB. So if you see, I don't have the page number. Yeah, but just to get to the right page. Okay, so OPEB is on page 80. Yep. Oh, she is. Okay. Okay.
Following her right now, she's still there.
All right. Okay. All right, so while we wait for Jen Castellano, we'll move instead to, active employee benefits, which is Department 1320. So the general fund amounts for health insurance are on page 84 of the budget book. Additional amounts for the self-sustaining funds are on page 85. I do believe we have an update to these amounts in the backup, in the supplemental backup for tonight's meeting. So looks like a few pages in, and it starts with July 1, 2023 renewal projection. It's Carlton. Remote?
Carlton actually has food poisoning.
Oh, great. Okay.
So his counterpart Joel is on.
Right.
He did expect to go a little bit later, but I don't know. Joel, do you mind going earlier? Joel, I think you may be muted.
Move him to the stage instead of Rick.
Yes. Hi. Can you hear me now?
Yes.
Yes.
Sorry about that. So, sure, I'm ready. If you'd like me to start.
Yep, that's great. So we're tell us where you want to start. We have this updated renewal projection that we got today, and so we can follow along there if that works.
Yeah, I suspect, Frank, that's what we talked about this morning, right? That same document. I'm happy to share my screen here if that
Yes.
helps as well.
So usually, just as so the renewal projection that you all have isn't the updated one. Usually we have numbers through February right now, but because Carlton has been out of commission, this around this time would be the earliest that we would get them. So I think we'll have them hopefully by Monday. I talked to Joel about it today. So this is the data that we had as Board of Selectmen.
Okay, and this is different than what's in the budget book?
Yes, it is different
Okay.
than in the budget book, but it was updated by the Board of Selectmen. The version that you have was reflected in the Board of Selectmen's update to
Got
the
it.
budget.
So we're gonna get another one of these Monday?
Most likely, yeah, with just some experience updates.
Okay. All right, you're ready.
Okay, so I'll share my screen just so that you can see the same page that I'm on here. And there are pages to this. Most of this is on page 6. There are several pages of kind of backup data that feeds into the overall projection. Right, so page 1 here is a monthly view of your claims experience, broken out by your active employees and your retirees under 65, your retirees over 65, pharmacy claims, dental claims, and a total. And then the next page 2 is the monthly head counts associated with each of those categories, the enrolled lives for each of those plans and categories. And then page 3 summarizes all of the administrative fees for adjudicating claims and, clinical programs and all of the administration that goes into your programs. You'll see here, I'll point out this current plan has a $26, that's a per employee per month fee that is charged by Anthem for administering your claims. We are in the process of doing a market check, an RFP project, request for proposals from Anthem, as well as several competing carriers. And so we see that that administrative charge has been reduced from $26 per head down to $21.71 per head. So some favorable results there. Underneath that is the stop loss coverage, which is a fairly sizable increase percentage-wise, and that's pretty typical in the stop loss industry. A general kind of average trend rate is between 15 to 20%. You've got a 22% stop loss renewal due to some poor experience that we see in the program over the past year. The next 2 pages are a listing of the large claims experience, and a couple of these highlighted in red are what are feeding into some of the stop loss renewal provisions that we'll see in the projection as well. Regarding 2 lasers that have been imposed on the stop loss renewal, meaning your general stop loss deductible kicks in when an individual hits $150,000 in claims. A laser means that these 2 particular individuals have been applied a higher individual deductible going forward. Due to the ongoing nature of their large claims. And then all of that claims information and fee information kind of feeds into this projection of the next year's cost of your programs. Again, the same categories across the top of active and retirees under 65 and the Medicare retirees over 65. and then the pharmacy experience and the dental experience. And overall, this results in a projected increase of 6.6% to your healthcare budget for the upcoming fiscal year, which is generally in line with average market trend in the area of 6 to 8%. So I know that in the past, Carlton has walked through the components of that projection. I'm happy to do that as well, if you like. And I could use this first column of the active employees as the example. The process is the same across each of these categories. But essentially, we begin with the latest 12 months of claims experience, and we remove the large claims experience in excess of that stop-loss deductible because any of those claims are covered by the stop-loss insurance. And then further on down the row here, we add in the premium for that stop-loss insurance. So the net claims less the stop-loss reimbursements then gets trended forward at an average trend rate for medical at 6%. We apply 17 months of trend given to take the experience period that we're looking at and project it forward into your next fiscal year. So the trended claims become this 8,586,000 number. We put that on a per capita basis by dividing by the average monthly head counts, and then adjust it for the projected going forward head count. So it's not much of a difference, but there's 465 lives in the experience period and a projection of 467 lives in the go forward projected period. So the claims are adjusted for the head counts, and then this $600,000 represents the additional liability for those two lasered individuals on the stop loss renewal for total adjusted claims of $9,226,000, and then we add in those administrative fees as well as the stop loss premium to come up with a total estimated cost for the projected period. Sum that up across all of these categories, and the end result is a $22,229,000 estimated cost for the upcoming fiscal year, which we compare to the current premium of the budget rates, premium equivalent rates that were established for this year, and it's a increase of $1,375,000 or 6.6%. And then underneath that, we just break out those subtotals between the medical, the prescription drug, and the dental program. Any questions?
2548. Prescription drug is $689. Mr. Matola?
Just a general question, and Frank, maybe, I don't know if you know this, you said these numbers will change on Monday, possibly?
Yes, because basically what we'll get is they'll only change to reflect the new month of claims experience. So you're going to have a month of claims experience drop off and a new month come on.
So there's no indication which way these numbers are going to go?
There's no indication of which way they'll go. I can say that between what we proposed from the first Selectwoman's budget to the Board of Selectmen budget, there was a $265,000 swing. That was
Favorable or negative?
Unfavorable.
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 But that was due to changes in the stop loss coverage. With this updated renewal, with these updated numbers, we would the stop loss factor is taken out. So it would just be an update for it would be an update for claims experience. So, you know, I don't think you would get as dramatic of a swing.
Thank you. Thank you.
Other questions? Mr. Walsh?
Good evening, Mr. Chamberlain. How are you?
Good, thank you. How are you?
My name is Jim Walsh. I'm one of the members of the board. So the stop loss is going up 22%. I'm having a hard time understanding. It's going up 22% even after we're lasering the highest claims, correct?
Yes, that's correct.
All right, so this lasering, I guess it's got to be legal, right? Because I thought under Obamacare, like pre-existing conditions, you couldn't have that anymore and things like that. But I guess in stop loss, you can still basically negatively impact people who have pre-existing conditions or illnesses, correct?
Well, the stop loss insurance wouldn't have any impact on the individual.
No, it doesn't have any
So-
impact on the individual themselves. It has
Right.
it has a huge negative impact on the people who pay the premium, though, correct?
Yes, it does.
That's the town of Fairfield,
Yes.
correct? All
Yes, that's correct.
So explain to me, if you take those claims out, large claims, and you change the number on the stop loss, why would we still be going up 7%? It just doesn't seem to make sense.
So the stop loss, the premium renewal went up 22%, and then they lasered these two individuals. Now in the state of Connecticut, the stop loss laser cannot exceed 3 times the deductible amount, and so that's what they've applied here. Is that the individual deductible amount on the stop loss currently, and for several years now, has been $150,000, and these two individuals are expected to have ongoing claims into the future, and so they've each been lasered at a $450,000 individual deductible amount, which is an extra $300,000 for each of these individuals, and that's where that estimated laser liability of $600,000 comes from. So there is they can laser, and obviously they do. It has not been their practice for a very long time, but they have implemented this laser at this renewal. And have been limited at that $450,000 mark. And the reason that they do that is, basically because they can, and they see this as a known risk, and so they laser this individual out. I mean, the alternative would be to simply increase the premium by a much higher amount to cover it for it. So they're going to underwrite it, and get the same premium one way or the other. But the laser amount, applies just to those specific individuals, such that if they were to leave the plan, or if they were to not have claims as high as the laser amount, then you would see the benefit of that. But that's frankly an unlikely occurrence. They think that these folks are going to have ongoing claims at this level.
Before, can I just ask that you stop sharing the screen, please? We have this in front of us. It's, can't really see it anyway. Thank you.
Sure.
Sorry, Jim.
And I'm looking at page 10, I guess, of this report, your company's report. And what's the cost for the stop loss? Which is the number that? Is it 1,000 at 1.8 million? 1.87 million?
It's currently 1,884,000, and the renewal is at 2,298,000.
2,298,000. Okay. And how much benefit did we get last year from the stop loss? How much did that save us?
I could certainly follow up with that number. I don't have that number in front of me.
You think it's more or less than?
Is that going to be these large claimants?
It would, is it going to, you think it's going to be more or less than the 2.3 million approximately dollars? $2.3 million.
I could check. I actually may have it.
keep going with questions because it'll take me a little bit.
Because it going up
Yeah,
at 22%.
and there has been a swing. I mean, and that's the nature of stop loss insurance, is that these large claims tend to, you know, have quite a bit of volatility around them. Whereas, you know, you may kind of, you know, quote unquote, beat the insurance company one year and then, you know, and then lose the next year. But there, because, you know, it's impossible to predict $1 million claimants, and you know, there's a lot of volatility year to year. So I know that in the past we have put together some reports of that loss ratio over the course of several years. So that's certainly something that we can put together and follow up for you.
Because of the large increase and some large claimants, I'm just trying to figure out, like, I guess I'll use your words. Did we beat the insurance company this year? Like, we got more benefit than our premiums? Because if we didn't, and we're still going up by 22%, it makes you start questioning whether you should even have it.
I can
Yeah.
say
So in this report showing the latest 12 months of claims, there's $2,061,000 of claims in excess over the stop loss in stop loss reimbursement, over $2 million versus the $1.8 million that you're paying in premium.
Understood. It would be great to see and experience how we've been doing with that, say, over a 10-year period of time.
Yeah, we can do that. I don't know if I could go back 10 full years, but we certainly have a lot of history that we can put together and share with you.
Only because at 15 to 20% increases, that number's going to get pretty large, pretty fast going forward.
Yeah.
And it's really going to increase the cost of the insurance for us.
Yeah, I will also share that we are in the process of marketing this coverage as well. So this is the offer that we have from Anthem, but there are third-party stop loss insurance carriers that we will be gathering quotes from and have that information within the next couple of weeks.
Okay, so as our broker, you don't put that out to bid every year?
Yeah, we do. We can. And it has not gone out to bid every year due to the decision of the town. But yeah, it's out to bid now and can go out to bid every year. It's pretty standard for us to take it out to bid on an annual basis. But the nature of stop loss insurance is that the carriers will require at least 9 months of experience data in the policy year, and so that's the timing issue here, that we can't get those quotes from the carriers until we're into April and have claims data through March to be able to share with them.
Joel, just to clarify, I know we could do it every year, but I think when we spoke, you said the general practice is every 3 to 5 years, correct?
So on a medical or a dental, bid, that's generally on a multi-year cycle. Stop loss really has no impact or disruption to employees or the plan, and is a much easier coverage to market on a more frequent basis.
Well, it still seemed like we should probably do it every year, even if we approve the money in our budget, because even if you wait for the certain months to come in and you can save money, why wouldn't we want to save money?
You could do that.
Yeah, absolutely. On the stop loss, you could. I mean, I think generally speaking, Joel, like, there's a chance that we could save money. But to be honest, I think, ultimately insurance companies are going to get the claims information, and they're gonna get the same information that Anthem has that led them to charge the premiums that they're charging. So, you may save a little bit, and we could do that moving forward. I was more speaking to the medical and the dental on the 3 to 5 years. I wasn't delineating.
I understand, and I understand why people, companies, and I've worked with companies who have put this stuff out sometimes every 3 years, sometimes every 2 years, but I think we should keep everybody honest, because some companies are going to be hungrier for the business than somebody else.
Yep.
And I think it would be good to, at least it sounds like on the stop loss, every single year.
And to Joel's point, I mean, this year, that's what we're doing. So we're gonna see what it yields.
Sure.
My thought was, we're not gonna know before this board votes on it. Obviously, if it costs us more, the RTM can't add, but it can reduce. So the only instance we would have is if it can reduce, and hopefully we'll know more information before they vote. So if maybe there's an option to reduce that stop loss, they can do that. Otherwise you just end up.
Right. I'm also.
Thank you, Jim. Question, where did we come out versus last year's, where are we trending versus last year's projections? I don't know who to direct that to, but I know last year there was a lot of concern about, the impact of COVID and all that stuff. And, we were concerned that, we might have a much higher increase than we ended up, than we were budgeting for. How did we?
Yeah, it never manifested itself.
I don't think it did, but.
So actually, we were showing a favorable in the internal service fund.
Okay.
In the FY23, I think it was a favorable balance of 23 on the insurance side.
23.
Oh, sorry. I said the fiscal year. 300,000.
Okay, so we were pretty close. Okay.
Yes.
We're pretty close. Okay.
I mean, obviously data changes and.
Yeah, but I mean.
In the year.
Okay, no, that's good to know. Okay. All right, so we're good. So we'll get an update on this Monday. And the numbers are going to be what they are, but does anybody else have any questions about kind of how these amounts work? I know mostly everyone has been through this before, but Mr. Stark?
Yeah, I think I found the answer to my question, and I just want to make sure it is the answer. The actual cost of those 2 lasered employees is on page 6, is that right? That's 600?
So there's the increase to the premium, and then there's the 2, the increases in the deductible that you would have to pay for those lasers.
Are they shown here?
The 600,000 is the increase in the deductible.
Okay.
The 22% increase in the premium is what Joel was.
For those 2.
For the whole stop loss. Yeah, so you have, if on page 8 and 9, you have this, the claims that hit the stop loss. There's 29 of them.
Okay, so the only cost specifically identified to those 2 people is the 600. Correct.
Yeah. Okay.
Running as I go on this.
All right.
I was too. This is new to the town, hadn't been done before, and it's not done a lot in municipalities, so it was new to all of us.
But did Mr. Walsh ask what that number would have been if we didn't hit the laser? Was that your question? What would the 22% have been if we didn't laser those 2?
No, I didn't. No. I think I was asking more what the total cost was, and I think they got it. What was the amount we received as benefits versus what we paid?
Yeah, and that's what's on here with those stop loss. That's the
Yeah,
2 million
stop,
that's on in
yeah.
the pages. Okay. All right. Any other questions on insurance? All right. Well, thank you, Mr. Chamberlain, for pinch hitting. Appreciate it. And I guess we'll see you next time.
Thank you. Good night, everyone.
Good night.
Milliman is on.
Milliman is on. Okay. All right, great. Okay, so we're gonna move back to OPEB and pension. And so in your books, this is another set of numbers that's been updated, but in your books, OPEB is on page 80. And that is those are the general fund numbers on page 80 for OPEB and pension. And then you'll see on the following pages, you have all of the numbers for OPEB and pension, including the self-sustaining funds. So But these numbers again have been updated. And the updated numbers are in the backup. And Jen Castellano is here with us. Are you, I see you in the corner. Could we? Okay. And then, Jen, you have a presentation to take us through?
Yes, I do.
All right. Well, welcome. Good to see you again. I hear you were double booked tonight. So welcome to your second go around of this, I guess.
Thank you. I was tempted to just hit record on the last one and press play for you guys, but I'll give you a fresh presentation.
Okay, so I'm just gonna, it would be good to have you on the screen if we could. I just want to let everybody know. So if you're, for those who are joining remotely, in the supplemental backup, the presentation starts, it says page, I don't know what page of the PDF, it says page 18, right?
20 of the
20 of the PDF, 18 in the right-hand corner of the document. And so for board members who are here, maybe let's just flip to our hard copies so that we can see Ms. Castellano on the screen, if that's okay. All right, we are ready when you are.
Okay, is page 18 the pension plan or the OPEB plan first?
It's with
the OPEB.
OPEB, yep.
OPEB, okay. All right, so this is the first OPEB valuation that Milliman is performing for the town. As you probably know, the OPEB valuations are performed every other year in even years. As part of the valuation process, we collect the membership data as of July 1st. We analyze the demographic experience over the last 2 years, as well as the asset performance. And we look to see how those factors impact the plan's funded status. As part of our process, we monitor any trends that we may see arising and as with respect to the assumptions that we use for future years. We put all that together to calculate a liability for the future promised benefits to plan participants and determine the town's contribution to be made to the OPEB trust to fund these future benefits.
By the way, Ms. Castellano, we can, so for everybody, for board members and anyone else, so the page numbers in the right-hand corner of the big PDF, in the bottom-hand corner, Ms. Castellano, we have the pages of your document. So if you want to flip through, so page 2 is the first one that we're looking at that says plan population for OPEB on top. So if you want to start us from there, that's great.
Great. Okay, so the plan on page 2, we have the plan population for the OPEB plans over the last 3 valuations in 6 years. Both of these plans are still open to new hires, so the active membership is remaining fairly constant from year to year. And likewise on the members and pay status, the lighter blue sections, that's fairly constant. I want to point out one thing with respect to our numbers, which are in the 22 column for those light blue members and pay status. For our purposes, we report that number based on the number of contracts in place for each retiree. Hooker and Holcomb's numbers, which are in the 2 left-hand bars in each graph, represent also beneficiaries and spouses of retirees as well. So there's a slight discrepancy there, but we feel it's more accurate to represent the total contracts as opposed to the previous. Moving on to the next page, we have a distribution of the active membership for each of the plans based on age and service. For the police and fire plan on the left-hand side, the distribution is fairly spread out over earlier ages and lower years of service, all the way through later years of service and age. The OPEB eligibility for the police and fire plan is generally speaking 51 and 25 years of service. So if you look to the bottom right-hand corner of that graph on the left, you can see that about 10% of the active population is currently eligible to retire with an OPEB benefit. Moving on to the town plan, the OPEB eligibility is later. It's 62 and 10 years of service for all town employees, with the exception of public works, which is 59 and a half and 10 years of service. On the town side, about 10% of the active population is eligible to retire as well. And you can see that the distribution is pretty evenly weighted throughout all years of service and all different age ranges. Moving on to page 4 of my document, we're looking at the plan assets over the last 5 years. Now, for purposes of calculating the OPEB contributions, we are not currently utilizing a mechanism for smoothing investment gains and losses, also known as an actuarial value of assets. For the pension plans, we are, and I'll get to that in that presentation. But for the OPEB plans, we aren't currently doing that just yet, and that's because the OPEB plan is still, the trust is still fairly, well, I'll say young, and the funded status of those plans is not quite high enough to merit introducing asset smoothing. We likely will explore that in the near future, possibly with the next valuation in 2024. But as a result, you can see the market value of assets is a little bit more volatile, and you can see the asset value decreased from 2021 to 22, reflecting the difficult investment performance in fiscal year ending 2022.
But just Hooker and Holcomb did use smoothing.
Not for the OPEB plans.
They didn't? Okay.
No.
Only for pension. Okay.
Only for pension. We thought about introducing it this year, but it's not optimal to introduce asset smoothing in a down market, because what it does is defer future those investment losses to future years, which will just put upward pressure on your contributions in the future. So we thought it was best to just recognize that all now, and then we'll reevaluate when we do the next valuation in 2 years.
It doesn't get worse next year.
Hopefully not.
It's going to get really bad. That's understandable. Yes, thank you.
And can I just ask a question? So we don't do smoothing, but we do the valuation every 2 years.
Correct.
So what does that mean? So the second year of the 2-year period is.
So the second year of the 2-year period, what we typically will do, there's 2 options. And historically, what has been done is we take the contribution that we calculated with this valuation and add an interest component to take into account the time difference from when we calculate the first contribution to when you're going to make the second contribution. Another thing we can do is project liabilities. So we won't recalculate liabilities because we're not going to collect new census data in the off year, but we can project liabilities on an actuarial basis, but then reflect actual investment performance in that interim year, and recalculate the contribution on that basis. That's a more accurate calculation of the actuarially determined contribution. Either method is acceptable. I've seen towns do both different towns do different methods. So that's something we'll likely discuss as we get into next year, is the best approach for calculating that contribution.
Okay, thank you.
On page 5, we have a 5-year history of the investment return. So as everyone in the room, I'm sure, knows, the last 2 years have been quite volatile. You had almost a 30% return in fiscal year 21 and an almost negative 14% return in fiscal year 22. Typically, this is why we would smooth assets, is to avoid this volatility. But when you think about the relationship of the plan's assets to the liability, both plans are about 40 and 50% funded, police and fire and town respectively. So the liability number is a much larger number. So swings in the asset value don't have as much of an impact on the end result of the contribution as it would if the plans were closer to 100% funded. That volatility doesn't impact the end calculation nearly as much. But as the plans become more and more funded, that's why we'll want to start introducing the asset smoothing mechanism to help avoid future volatility. Moving on to page 6, We get into the funded status of both plans. So we looked at the assets, we looked at the liabilities. How do they compare to each other? And you can see on the graph on the right-hand side, the funded ratio of the plans has been steadily increasing over the last several years. You can see that the town funded ratio from 2020 to 22 increased more than the police and fire funded ratio. And the reasons for that is the experience for the police and fire was not as favorable as it was for the town. And I'll get into some more specifics with respect to that. And it's primarily as a result of Milliman's analysis of expected future healthcare costs for your retirees. As you probably know, there's two different types of plans. You have your retirees that are under 65 and your retirees that are over 65. The under 65 plans on average for the police and fire plan, the expected claims, future claims for pre-65 retirees was 19% higher, grew by 19%, higher than we expected. Whereas the post-65 plans decreased by 16% over what we expected. Now, the police and fire liability is pretty fairly evenly split between pre-65 plans and post-65 plans, so they pretty much offset each other. The end result was a slight gain due to the expected future healthcare costs based on our analysis to the liability. So the liabilities on average overall was slightly lower than we expected it to be. But then we examined the expected medical inflation component, so how healthcare costs will grow out into the future. Because remember, for a good portion of this population, they're not receiving this benefit for another 10, 15, 20 years from now. So we have to project out those costs way out into the future. And medical inflation the expectation is slightly higher than it was in the past. That's driven primarily by the current high inflation environment. So short-term medical inflation is really high, and then it starts to tail out and balance out. But that did result in a slight loss to the liability. So the liability increased by more than expected as a result. We then lowered the interest rate assumption from 7% down to 6.9% to be consistent with the pension plans, so that all the plans are using the same interest rate assumption. So overall, the liability on the police and fire side was just slightly higher than we expected it to be. You combine that with the investment losses, therefore the funded ratio increased, but didn't increase by quite as much as we expected it to. Now on the town side, we saw the same experience with the pre-65 plans and the post-65 plans. So pre-65 plans increased by more than expected, and the post-65 plans decreased by more than expected. But on the town side, the liability is about 85% of the liability is attributable to the post-65 plans. And the reason for the difference between the town and the police and fire plans is the retirement eligibility for the two different groups. The police and fire groups can retire as early as age 51, so they have more years in those pre-65 plans, whereas on the town side, the average retiree is at least age 62, so they only have a few years in the pre-65 plans, and most of their time in the OPEB is spent on a post-65 plan. So the gains on the post-65 plan more than outweighed the losses on the pre-65 plans on the town side, resulting in a decrease in the liability by about 13%. That was slightly offset by the higher medical inflation assumption, and then also offset by the lower interest rate assumption, because as you lower the interest rate, the liability goes up. But overall, all these factors combined, the town liability was about 10% lower than expected. And that's why you can see that the funded ratio for the town improved more than the police and fire plan did. Moving on to the next page, we then take that and we looked at the funded ratio. Well, how does that equate to the contributions the town must make to fund these plans in order to pay future benefits? There are three components to the actuarially determined contribution. The first being what we call the normal cost, and that's the value of benefits expected to be earned by active employees over the course of the next year. That usually stays fairly steady from year to year, and it did so in this case for both plans. The second component is the amortization of the unfunded accrued liability, and the unfunded accrued liability is the difference between the plan's liability and the assets in the OPEB trust, and that difference is amortized over a period of time. That period is currently 19 years. So that component of the contribution for the police and fire plan increased from last year because the unfunded liability is larger because of the asset loss and the small liability loss. So there's a bigger base to amortize over time. And the last component of the contribution is an interest component, just to take into account the lag in time between when we calculate the contribution and when the contribution is actually made into the trust. So on the police and fire side, you can see that the contribution increased by about $300,000 from $5.6 million to $5.9 million this year, and that's mainly due to the investment losses, as well as the slight liability losses that I talked about on the previous slide. Moving over to the town side, you see that the contribution dropped from 4.2 million down to 3.6 million, and that's mainly a function of the significant liability gains we saw, and I talked about on the previous slide. There were some investment losses as we spoke about, but the liability gains were much larger than the losses on the investment side. Therefore, the resulting town contribution is lower as well. All in all combined, the total contribution is down about 300,000 for both plans combined from fiscal year 23 to fiscal year 24. Page 8 is our analysis of the interest rate assumption used to determine the plan liability. The interest rate assumption is equal to the plan's expected return on assets. So what we do is we take a look at the target asset allocation for the plan, and in this top graph, you can see a graphical representation of the plan's asset allocation. Each dot on this graph represents an asset class. The larger the dot, the higher the allocation to that asset class. And where that dot falls in the graph represents the expected return relative to the riskiness of that particular investment class. And the black dot in the middle of that represents the entire portfolios and the risk return profile associated with it. Now, in any given year, the plan's investment returns can be really, really good or really, really bad. I mean, we've seen that in the last 2 years. Fiscal year 21 was great. Fiscal year 22 was not so great. But as we look at longer and longer periods of time, the expected returns tend to move towards what we call the 50th percentile. It's those black numbers through the middle of that bottom graph. And for the OPEB plan, we look to a 30-year time horizon, because remember, these are long-term obligations in nature. The obligation, quite honestly, moves beyond 30 years, but predicting beyond 30 years is not. 30 years is a long enough period with respect to this analysis. And you can see that our expected long-term rate of return for the OPEB's portfolio is about 7.4%. Now, that being said, we recommended and we moved the discount rate down to 6.9% this year to be consistent with the pension plan. That has been the past practice, and it is a very conservative assumption. Capital markets assumptions are particularly high right now. They're much higher than they were this time a year ago, and we don't know if that is a new normal or just a short-term trend, but we're monitoring that, and we don't want to overreact to that at this point in time. So we're going to get to 6.9%, which is what we decided 2 years ago. When we did the next valuation, we would drop to 6.9%, and so that's where we're at currently. And the last 2 pages of my presentation are just is everything I've already presented, but just the detailed numbers for those who are interested in those numbers. I'm not going to go through them today unless someone has a question and would like me to answer something specific. But this does just show you where the numbers fall. The final results for this year are the numbers in the far right-hand column of both pages. And that's what I have to present on the OPEB plan at this point. I'll leave it to any questions you may have.
Thank you very much. Questions from the board? Mr. Welsh.
Mr. Castellano, good evening, and thank you for being here. Thank you for the very thorough presentation, delivering us some good news. In previous years, when we've had this presentation, and I think it's with your firm, I'm not sure, but definitely with the previous firm that was in the same position you're in, we got some answers on where we stood regarding the funded ratio versus other communities in the state on OPEB.
Mm-hmm.
Could you give us any information in that regard, if you know it, or maybe if you don't know it right now? I don't want to hold you up and have you start researching it right while you're here, but you could get it to us at a later point in time. I'm just trying to figure out on OPEB where we stand and against other communities, and specifically against AAA communities.
Yeah, so I'd say that in the state of Connecticut, about half of the towns who have OPEB plans even have a trust. So I'd say about 50% or so don't even have a trust, so their funded ratio is 0. They're just they do pay as you go. Your plans are at 40 and 50% funded. I'd say that's probably middle of the road for most towns in Connecticut. Now, as far as AAA communities, I wouldn't know that quite off the top of my head. I do have some clients that are AAA rated communities, and they range anywhere from 20 or 30% funded to 60, 70% funded. So again, this is a slight speculation, but I'd guess that you're probably middle of the road with respect to the OPEB funded ratios for your plans.
Okay. And under the current plan, we are under, and if we follow the contributions that we're actuarially supposed to make, when would we be 100% funded?
So the funding mechanism is set up so that you're 100% funded when the amortization period reaches 1. So 19 years.
19 years.
That's absent any gains or losses, obviously.
Gains or losses,
Yeah.
big fluctuations.
Yes.
Changes
to the plan.
Usage,
Yeah.
Changes in plan, changes in the usage of the plan and history and all that stuff.
Mm-hmm. Yeah, assuming all of our assumptions come true every year. Yeah, because we have a crystal ball.
Okay, so we're still 19 years away.
Yes.
Okay.
But just to follow up on that, though, I mean, obviously, the assumptions don't come true every year, but you still adjust, right? So you're just amortizing that unfunded liability, right? So
so even still, you would become
asset
funded
values,
after.
Plummet next year, right? We'd be amortizing we'd have a higher
Right.
amortization. Yeah.
Right. Yeah. So absent any changes to the amortization period, it would still be 19 years. Now, sometimes if asset values plummet so significantly that you can't withstand that swing, then maybe we look at the amortization period and revisit that. But absent any changes to that policy, no matter what happens, after 19 years, you'd be 100% funded.
All right. And how many years in are we? Are we 10 years in, 11 years in?
I think you reset to 25 years a couple years, about 6 years ago, I believe.
Okay.
So I'd say you're 6 years in.
Okay, we're 6 years in. Okay.
Yeah.
Do you know why the reason for that reset at the time?
I don't. That was prior to Milliman's time on the account, so I don't know the logic for that.
Neither do I. That's what I was asking. I thought
It could have been when you started the trust potentially. I don't know exactly when the trust was created, but that possibly could have been when the trust was created.
And because we're in the trust, we get a benefit for that, correct?
Right. So because you're in a trust and you're actually contributing to the trust. You know, there's communities that have a trust with a little bit of money in it, but don't actually contribute to it. For all intents and purposes, those are communities that are not funding their OPEB plan. But because you're in a trust, we can use the long-term rate of return assumption for purposes of discounting the liability. So that's the 6.9%. If you didn't have an OPEB trust, we'd be using a discount rate that's closer to 3.5% this year, which would be a much higher liability than the liabilities you see.
Thank you very much. I appreciate it.
Okay, Mr. Walsh. Anybody else have questions? Okay. Just one question, Ms. Castellano. I recall in the past, and I'm thinking of last year specifically with H&H. So they gave us, and correct me if I'm wrong, Jared, but I thought we got 2 years ADAC at the same time, but you're not doing that. You're giving us the current year, and you're going to calculate a new number next year. You're just not going to pull new census data to do it, right?
Well, there's two options for that. We could just add interest to the current year. That's the easy way to do it. But that won't reflect what happens in the market during fiscal year 23. A better practice would be to do that. We could do either. One would cost more than the other as far as our fees, and so I'm agnostic to which method the town wants to use. But before we issue this final valuation, the final valuation report this year, we'll want to come to an agreement there, because if you want to do the method where we just add interest, we would include that in our valuation report this year. Otherwise, we would do an interim off-year calculation.
Or you would look at asset valuations next year and factor that in.
Yes.
All right, thank you. Other questions? All right, well, thank you. Thanks for doing double duty tonight. Oh, wait, pension.
Not done yet.
Say don't think or too.
What time is it? You would think it was 11 o'clock. It's only 8:30 and I'm already off my game. All right, pension. We are blowing through it.
Great expert.
All right.
That's because the presentation is
Very good.
It was good.
Great
So,
presentation.
Admire all of your
Thank you.
actually, I wasn't optimistic this morning. So, all right. So pension plans for those following in the online backup, the presentation starts on page 31 of the PDF or page 29, the right-hand corner. And for board members, obviously, Town of Fairfield pension plans. So, Jen, I guess we can start on page 2 of that presentation with you.
Okay, thank you. So like the OPEB valuations, we do the same for the pension plans. The only difference being for the pension plans, we do this on an annual basis. We go through this analysis. So we collect census data every July 1st, not just in the even years. On page 2, again, we have the history of the planned population over the last 5 years. For the police and fire plan on the left, that plan is still open to new hires. So you can see that the active membership, the dark blue area, is fairly consistent year over year. And the members and pay status are slowly increasing as active members retire. On the town plan side to the right, that plan has been closed for a number of years now. How many years the number of years is different for each town union, but on average about 8 to 10 years or so. So you can see that the active membership in the dark blue section of the bars is declining year over year as active members terminate employment and retire. They're not being replaced by new hires. The new hires are going into a defined contribution plan. And again, the members and pay status is growing as well as people retire. Moving on to page 3, we have the distribution of the active membership for each plan. Again, the police and fire, this distribution is going to be fairly consistent with the distribution we saw for the OPEB plans. It's not exact, We're still working with HR to get to figure out exactly why, but it's only off by slight amounts here and there. Nothing that would be materially change the numbers in any way, shape, or form. On the town side, though, you can see that the distributions are more heavily weighted towards the higher ages, the later ages, and the higher years of service. That's because the town plan is closed. So as time goes on, that plan is going to become more and more mature, eventually to the point where there are no active members left in the plan. Moving on to page 4, looking at the plan assets over the last 5 years. So for the pension plan, we do use an actuarial value of assets where we recognize market gains and losses over a 5-year period. You'll note that in 2021, the market value, that's when we had our strong market returns in 21, the market value was higher than the actuarial value because we were deferring for 80% of the gains in 21 to future years. Then 22 happened and had negative returns, and those losses, investment losses, completely wiped out all the gains in 2021, and we're now deferring some losses out into the future. As a result, the actuarial value of assets currently exceeds the market value of assets for each plan by about 12 or 13 million dollars. What that means is that absent any future gains or any future gains, the recognitions of those deferred losses will put upward pressure on the town's contributions over the next several years. Moving on to page 5, we have the graph of the investment returns over the last 5 years. The dark green boxes represent the market value of assets. So, and the lighter green line represents the actuarial value. And so this is exactly why we smooth assets for purposes of calculating the town's contribution. You can see that lighter green line is not nearly as volatile as those dots, especially in the last couple of years. And it helps to provide more stability for the town's contributions to the pension plans. Moving on to page 6, we have the funded status of the two plans. Looking at the funded ratio graph on the right, the funded status has remained pretty much level from last year to this year for both plans. The police and fire maybe declined ever so slightly, and the town plan increased ever so slightly, but for all intents and purposes, it's the funded ratio stayed level. On the police and fire side, there were some experience gains resulting from more retiree deaths than expected and more retirements than expected. So that produced gains, which means the liability did not grow as much as we expected to because these people retired sooner. More people retired and then more people died than we expected. However, those gains were completely wiped out by the cost of living adjustments that were implemented this year for the police and fire plan. We do cost of living adjustments for the police and fire plan every 2 years on the even years. And that is based on CPI. And because inflation is currently higher, very high right now, that resulted in a higher cost of living adjustments than we were assuming. And so that resulted in a loss to the plan, which basically offset the gains. Overall, the liability for the police and fire plan was about just under 1% higher than we expected it to be. So the liability grew from 248 million to about 256 million. Moving over to the town plan, there are lots of retirements and deaths as well on the town side, so that resulted in a liability gain to the plan, so a lower liability than expected. But again, same story as with police and fire. The cost of living adjustments for the town plan were higher than expected, so that resulted in a loss and a higher liability. So that wiped out the gains from the other experience. Again, the overall liability was pretty much where we expected it to be. So the end result is that the funded ratio stayed level. So despite the investment losses, which were somewhat mitigated by the asset smoothing, the liabilities not growing more than expected and pretty much staying following where we want it to be resulted in a funded ratio that is pretty much the same as last year. And moving on to the actuarially determined contribution on the next page. We have the same three components for the actuarially determined contribution as with the OPEB plan. You have the normal cost, the amortization of the unfunded accrued liability, and the interest component. On the police and fire side, the normal cost was slightly higher this year than last year, and that's to be expected in an open plan that is still bringing in new hires. As service and salary increases, we expect the normal cost to increase over time slightly, but in a steady manner. The second component, which is the amortization of the unfunded accrued liability, is higher because the unfunded accrued liability was higher. Again, with just similar to the OPEB plans, that amortization period is 19. So those two factors combined resulted in a slight increase in the police and fire contribution from 6.7 million last year to 7 million this year. On the town side, the normal cost decreased from last year to this year, and that's primarily a function of the fact that the active population is decreasing. So with a closed plan, as active members retire and stop earning benefits, we expect the normal cost to decline year over year. So that's what's happening here, and we expect that trend to continue into the future. The unfunded liability, the amortization of the unfunded liability did slightly increase, primarily due to the investment losses and the higher unfunded liability. Again, that amortization period is 19 years for the town plan as well. The end result is that the town plan contribution did decrease by about $100,000 from $5.1 million last year to $5 million this year. Moving on to the next page. It's a similar analysis with respect to the interest rate assumption as we did for the OPEB plan. The only difference here is that the target asset allocations are slightly different than with the OPEB plan. The OPEB plan has a slightly higher allocation towards equity, and the pension plans has a slightly higher allocations towards fixed income. That's likely because the OPEB plan has a lower funded ratio, so you're trying to have more risk return-seeking assets in your portfolio. Doing the analysis here results in a long-term expected rate of return of 6.9%, which is the assumption that we used last year and we're continuing to use this year. So with respect to the interest rate assumption, we're right where we want to be right now, and we'll continue to monitor this as we go on in the future. And again, the last two pages are just the results, the nitty-gritty details, the numbers of our results for both plans, and the far right-hand column represents the final numbers for fiscal year 2023-24. And at this point, I'll open up to any questions.
Okay, thank you. Questions from the board? Jim?
Good evening, Ms. Castellano. It's Jim Walsh again. Question, have you guys done any analysis on, as the town plan members decrease, like when are we really going to start seeing savings on that? How long is it going to take to start seeing, like, not $100,000 off, but like, you know, half that amount, like half the amount that we have to fund? How close are we to start seeing larger numbers on that?
You still have a fairly large active population, so I think that's probably out to the future quite a bit. We do put together a 20-year projection in our formal valuation reports that will show what we expect the contribution to do over the next 20 years, assuming all assumptions come true. The investments return exactly 6.9%. Everyone retires and dies and terminates exactly as we expect them to. So once we put that analysis together for our evaluation, that would give some insight into that. But you know, you still have a fairly large active population. It's still, you know, over 300 people. So unless it's probably several years before you start seeing significant declines.
Okay. And would that report also tell us what your estimate is for when we have nobody left in the plan?
That's not in the report, but I can get that number. I can get that date for you when we expect it. It's part of the numbers we run under the hood, but we just don't put that in the
Sure.
report. We don't put projected counts in the report.
Jim will still be on the Board of Finance by then.
No, Mary will be. Yeah.
But I guess if you look to page 3 of the presentation, you know,
That's wrong.
the youngest person is in their the youngest people are in their 30s, so you probably have at least another 30 years before
30
they
at
retire.
least. Life expectancy is 80, right? So
Yeah, but you have a lot of people.
Well,
Until
it's just-
people retire.
That's interesting though. I mean, and I had the same observation as Jim. You just look at these trend lines on page 6 and on page 7, and the funded status of the plan has barely budged in 5 years. And, you know, our ADEC is higher than it was 5 years, whatever happened there in 2018. But yeah, it's interesting. I mean, I guess the question is more, what would these numbers have been had we not
close to plan.
closed the plan, right?
Yeah.
Probably,
Yeah.
You know,
And part of the reason for the funded ratio not making progress is we have been slowly decreasing the interest rate assumption, so that does put upward pressure on the liability. So it helps to, and then you have your investment gains and losses that kind of make some noise too. But if the interest rate assumption were level throughout this entire period, you would have seen improvement on the funded ratio over the 5-year period.
Question I always have is, where would we have been if we
well,
didn't invest in Bernie Madoff? That's the question that wants me.
how much,
Yeah.
how much should we, do you remember? What was
We
the
had,
loss?
we had over $42 million, I think, in the fund at the time,
Yeah.
on paper, that was false profits. I think we received like
We got like
15 million.
15 million.
Then we had to pay legal fees and stuff like that.
Probably net 10, maybe.
11, maybe 12, but a $30 million
Better than
gap.
nothing.
Good thing we weren't into
Dramatic.
crypto or anything.
That's Yeah. Same bank.
But but the attrition on page 2, that attrition of active members is not that, it's not that severe. I mean, it's not like we're burning 100 people a year.
No,
We're like 30, 40 people, right?
Yeah.
And-
No, it's gonna be here for a long time.
Yeah.
All right, other questions? Other questions from the board?
Thank you.
All right, looks like you're off the hook.
Great
for
presentation.
further
Really
comments.
good presentation.
Thank you, we appreciate
Very
it.
thorough.
Thank you. You have a great night.
All right,
Joe.
thanks, see you soon.
Bye-bye.
All right, bye-bye.
So the question for Milliman, how do we know we have enough cash on hand in this program at all times?
What do you mean?
This is, the asset portfolio here is awfully similar to the banks that are failing lately. And one of the worst investments we've had over the past year is actually United States Treasuries, right?
Well, I mean, the banks, though, those are all current,
Yeah.
current liabilities, so they're deposits. What are we paying out of the pension plans annually? Do you know roughly?
Yeah, that would be the good thing.
Yeah,
Benefits.
yeah, benefit payments.
The presentation.
I didn't see it, but
Usually they.
That's been the past presentation.
I didn't see a payout, no.
yeah, we used to get more detail on that, but maybe just let us know.
Well, maybe in the.
Add it to the
Maybe in the back.
sheet.
Google sheet.
Add it to the.
So we can
thread
just
of
Google it.
We can Google it. All right. Okay, so let's, we're gonna move on then. Okay, so, we're gonna go on to, HR, which is Department 1330. So in the book, that is on page 87. The numbers start on page 87, and we can do this in whatever order we want. Who's here with us from? Do you want to?
Where are you gonna put these guys, Jared?
So they can do the operations side,
So when-
handle more of
Oh,
the
I'm sorry,
insurance and
I'm
claims,
sorry.
so they can sit here.
Okay, great. So is this Rob then?
I'm Rob.
Hi, we're sorry. Okay.
How are you? So
All right.
you guys can do the operations.
All right, so we're gonna start with it. No, let's start with insurance. Okay, so we're gonna start with insurance and claims. And we have Rob O'Connor here with us. Welcome. And so that's on page 87. And let's see, is there other backup to this
It's just in the budget.
or just the book?
Just the budget book.
Okay. All right, so this is, so if we go to the insurance and claims section, so that's the, under the operations subtotal. Rob, thank you for being here. Welcome.
So,
Turn it over to you.
Sure.
guess?
Yeah, I don't have this in front of me, so Frank, just,
yeah, I can walk, my understanding how this has went in the past, I can just walk through the budget and if anybody has any questions.
Okay.
Or property insurance is increasing or so on. With the property insurance, the numbers all there, increasing by about 8%, by about $36,000. This is the allocated amount. These numbers get allocated to ECC, WPCA. So
Frank, it's hate to interrupt. What line or line in the budget are you on?
we're looking at page 80.
Page
I'm on the page. What-
55 to 10, under the operations subtotal.
Okay.
Yeah.
Yep, I got it.
Errors and omission going up to 2%, 21,000, and the liability insurance going up 56,000. Understanding is, I think, talk more about the executive session. My understanding, speaking with Rob, is we've had claims experience, we've had some claims, so that to our increase. So it's pretty common knowledge that it's a hard market right now.
yeah, so, yeah, most of the insurance is with Karma. Karma's writing the property, the liability, the professional lines, and the auto. And, we're budgeting 8.5% increase with Karma this year. And that's a little higher than it's been in previous years. Because as Frank said, the claim experience has, increased in this recent year, and also, market factors. It's a hard market right now for the insurance market. Inflation's factoring in, reinsurance is factoring in. So there's a number of factors driving this, and so Karma is at 8.5%. Some of the other lines of insurance that are non-Karma lines are also experiencing some increases. We're budgeting. We don't, these aren't actuals yet. We try to be sort of somewhat conservative in budgeting, and we typically, are able to come in below budget, but because, we don't really have final numbers until probably, early June. So
Can you just maybe step back a minute and just like speak to the line items and just like briefly just remind everyone what's covered under these
Sure,
specifically?
yep.
Okay.
So the property insurance is the first section, and that's basically we insure all the town buildings, personal property, and also there's something called equipment breakdown that actually came into view this year, as we know, because there was
The digester?
with the digester.
Okay.
And that's going to be a significant claim. So that alone is, we put about $20,000 of additional premium for just that one event to impact that piece of the property.
And did you say vehicles as well?
Yes.
Okay.
So, well, no, not on property. So property is just strictly property.
Okay.
Break it out that way. And then you've got general liability. So general liability, basically the third party property and, and bodily injury claims that come in, slips and falls. So that would be,
That's liability.
liability insurance. Yep. And the liability insurance, the auto is lumped into that liability insurance line. Okay. So liability would be the general liability and the auto.
But where's the 8.5% you're talking about? Because that's only, property insurance is only 7.9 increase. You said you were factoring 8.5.
We are, yeah, 8.5% for Karma, and that's the Karma piece, which is about 80% of the budget, the premium. So
So are we not funding to the level we should be here? Are we shy?
Oh, we're putting 100% of whatever the premium is, we're paying it. there's just, in that line, you know, we have Kerma as the primary, but there's like the excess
80% of
flood.
that line you said, right?
Yeah,
It's-
80% is.
Yeah, I mean,
Kerma.
roughly, that's it.
So maybe that's the difference, Chris.
The other 20% is going down?
Is
Well,
it
that's the question, right?
is it
Yeah.
a question of what this, is the 7.9 budget to budget change and the 8.5 pertains to something else?
My understanding is what you're saying is, so you mentioned the 0.5. I think that's just the Kerma. The 7.9 is the budget to budget.
So it's coincidental that it's close, but it's not.
So was
necessarily.
last year's budget higher than, or last year's actual lower than our budget? Is that why?
FY22 actuals 432.
Or 32 for property? So that's why, okay.
Yeah.
So last year's budget was a little bit overstated, so consequently the
Oh, got it, okay.
increase looks, okay.
Okay.
Makes sense.
Oh, yeah, that's, okay. So you're looking at budget.
Yeah.
Looking budget to budget.
Okay.
Actual
I'm
to
looking at that.
budget,
Actual
it's
to
8.5.
Okay, that's okay.
Yeah.
That's the
No, that
difference.
makes total sense. Yeah.
Okay. Yeah, so property insurance, and then you've got, errors and omissions is basically your professional line, so that's, public officials liability, school leaders liability, so those claims fall under that. Those are, employment practices liability claims, anything that sort of falls in that professional liability area. That's a separate area. That actually is another area that's sort of under fire, and Kerma's book in general. Kerma insures, again, about 80% of the towns in Connecticut. So they have a pretty good handle on, claims experience, and they're seeing professional liability lines tick up. So
As a result of,
just more claims and more severity. And severity is a big issue right now in the industry in general.
what's
Claims.
underlying this? What,
Just claims, we call it social inflation is the word that's used. And it's just people now, when they sue, they're not getting 2 million, they're getting 8 million. I mean, it's just kind of gone really, really high. And so umbrella liability, for example, is another area, which is umbrellas are what pay a lot of that. We're seeing, significant increases in that area.
and this is why, and one of the things I think in the advanced questions was, we asked for a summary of our coverages and deductibles and everything. If we could, and I know you pointed to the CAFR, but that's kind of high level. If you could align that to this, I think that would be helpful for everyone. So sort of what's included, what, in terms of coverages, deductibles, like where is the umbrella, for example? Is that part of it, liability? Pardon me? Yeah, I
agree.
based on budget line item, I think that would be helpful. So the umbrella is under liability insurance,
Yes.
is that it? Okay. Yeah, so just, I think that would be helpful for the board to understand, because it's a little bit, and particularly when we get into risk management and we're looking at, what the various exposures are, it's not always easy to follow, what the town's exposure is. We have $100,000 deductibles here, 500 there, kind of helping.
Yeah, I
define-
mean, so
that would be
generally speaking, kind of the simple sort of description of the plan is, it's a high deductible plan. It's a $500,000 deductible for liability. Okay, so general liability, auto liability is the first 500,000 the town is basically funding in a deductible. After that, it's reinsured, call it.
Right.
Professional claims are 100,000. So for whatever reason, those have a lower deductible.
So professional claims, meaning those in this error and omissions line item?
Yes.
Okay.
Yep. So it's a $100,000 deductible.
Okay.
All right.
Do those, the discrimination claims fall under that
Yep.
category, those types of cases?
And then what about property insurance?
Property insurance is a $100,000 deductible as well.
Okay.
So that's the program. And then, so property is, without getting into kind of the weeds, is basically it's about a $600 million blanket property limit that we have for all the buildings. That's all the buildings and the contents and everything. And then there's the equipment breakdown that's part of that like the digester claim ended up, being covered under. So that's property. It's pretty fairly straightforward. And then, general liability, as I said, it's a $500,000 deductible, reinsured over that. And that's what's happening, which is, and Peter knows this, is that KERMA is stepping in and handling all the claims from $1, which is somewhat unusual with a plan like this. I mean, typically when you see a plan with a $500,000 deductible, it's not always that the insurance company is willing to handle every claim from $1 because of the cost involved in that. And usually if they do, they're charging. So KERMA is not, they've agreed to do that at no, so they're not charging back the town at all. And that's a significant, as we know, there's a significant amount of resources that are being put towards that right now by groups. I mean, everything from pothole claims to, the slip and falls that are, happening on a daily basis. So that the town, so town resources don't need to get tied up in that.
Got it. And what about, and the property insurance, how does that work with, in terms of buildings, what about flood risk?
Okay, oh, good, flood. So flood is a little different. So flood, PERMA has a $10 million flood limit that would basically apply. So there's a $100,000 deductible flood, and then 10 million, and we have a 5 million excess flood policy. So we have 15 million of flood for any one event, except, and that's the one thing, is except if it's in a high hazard zone. So if it's in an A or a B zone, which are the high hazard zones, Penfield Pavilion and things like that, it's a $500,000 deductible, which basically mirrors the National Flood Plan. It's what you can buy. You can buy $500,000 from the National Flood Plan. And basically what they're saying is, if you want to be fully insured for those properties, go buy a national flood policy through the government, which is how you buy it. And then we basically pick up from there. And we've done that pretty much on all the buildings that are in the high hazard zones. So we have national flood policies on all those, pretty much all those policies that are, that are in that flood zone. So that's the way, that's a good question though. The flood is a little different.
Can I ask you a follow-up question to that? Same.
Yeah, of course, yeah.
So you probably heard about the fact that if we don't do something.
Oh, well, yes. I listened to the meeting.
How much is it going to cost the town of Fairfield if we don't do that? How much is it going to cost us to insure our own building extra on those high?
I mean, it's that's sort of an unprecedented. If in other words, if they go, my understanding is first you lose the 10%, and then they basically eliminate the whole program.
Yeah, right.
Yeah.
I mean, it would be somewhat catastrophic in my opinion. Because you're basically looking at every, all these homeowners who now have flood, who have bank loans who require it, not being, so they're defaulting somehow on their loan.
So are you talking
I'm talking about how much is that costing the town of Fairfield?
I mean, is there private insurance available?
There is a private insurance flood market.
Yeah.
It's really new and sort of not mature yet.
Okay.
I wouldn't necessarily look to insure the town of Fairfield with it,
Right.
but if we had to, we could go there.
They have good insurance. I mean, Lloyd's of London's there.
Yeah,
Yeah,
I mean,
yeah.
I mean, it's a new and developing area.
Yeah.
They're trying to figure it out.
I mean, saving residential home buyers 30-40%. 30%, I think I save personally.
Yeah, if you're
On a residential basis, but I'm
Yeah.
not talking about town stuff. So.
No, you're right. I mean, if you're in the right spot, you can save over the National Flood Program.
Yeah.
But on the flip side, it could be, if you're not in the right spot, it could be very expensive and almost unavailable if you're,
Yeah, if you're like right on the water.
So, yeah.
So National Flood Program, so the cost of that though, where's the cost of that?
So that actually, right now we're spending, I have budgeted $21,000 for national flood policies.
Where are you looking?
It's not in those numbers. It's and I'm looking at a more detailed list here.
But it's included in those numbers.
It's included. Oh yeah. I'm looking at something that breaks it down. But so, and the interesting thing about the National Flood Program is they revamped the program, and the concern was that the prices were going to go up, and they actually came down. Go figure. But we actually went from last year. The budget number was 28, and we came in at 18.5. So, So it's not the
And
national.
Congress has to kind of, I mean, the funding is gonna run out and when they have to reauthorize it in September and I think.
Yeah, you don't want to go there.
They keep threatening that they're not, I mean, it's sort of the moral
billions and
hazard
billions
of
of dollars.
doing this. As long as the government offers insurance, people will continue to build in vulnerable areas. And so that's the whole. See,
Self-fulfilling.
it's kind of like, student loans. It's one of those things where, I mean, if the funding is there, it's going to encourage.
They are trying to figure it out. You're right. And it's definitely in, billions of dollars in the hole right now. Yeah.
I mean, the problem is that it was really created for farmers, with the Mississippi River.
Yeah.
And if you don't have this flooding, farmers are not going to plant their crops. They're not going to have all their equipment. They're not going to have all their buildings. And that's what's great. Now it's gone to, hey, let's insure stuff, in Long Island, right on the water, on stilts. And that's the problem. The original thing was for farmers, and now it's everybody right on the water or shouldn't be building them.
Lord, can I just ask a
course,
simple
yeah.
question
Yeah.
on one of the line items? I sort of, 55230, this is just, is it injuries? When you say interscholastic sports, is it?
That was eliminated.
It's eliminated.
I
2
think
years
the
ago.
Board of Ed picked it up,
I
yeah.
was talking about, that's what that was for, right? Yeah.
Back to floods if I could.
Yeah.
Yep. So, Penfield is currently insured under the Kerma policy, and I guess under flood,
Yes.
and AFP, and will be during construction and will be after construction? Or tell me how that's gonna go. How
Well,
coverage
I mean,
will be maintained?
Yeah, well, there's a we need to get a builder's risk in place. Yeah.
Okay.
So that's
Additional
something-
policy.
An additional policy, that would need to step in while that construction is happening. So.
Keep asking for select woman this, but I'm not the right person.
Is that included?
So, interesting that you bring that up. I did get an email from Kerma. I was hopeful I haven't even spoken to Frank about this yet. We had hopes that Kerma was gonna step in and do the builder's risk, for, I think, about $150,000 was what they had estimated, which would have been, I think the other number that you got was like 500,000. So significantly better, right? Kerma just said that their builder's risk company is declined to offer coverage. So that's on my list of things.
So where's that going to be funded from then?
I think that wouldn't occur, that would be while they're under construction, so that wouldn't.
Like
fill up.
this summer
Until after the next fiscal.
or next fall? Yeah, this fiscal year.
It'll be this fiscal year.
So shouldn't that be part of the total ask?
I think sometimes that's the budget, they
Is it
include
built
that in the
into
budget for
the
the
estimates we got?
building budget. It's included.
No.
Oh,
I thought that was
Make a change.
The RTM is going to be voting on this next week, right?
Tomorrow?
Tomorrow.
Yeah, if they,
Then we could deduct it at night or add it if it passes.
well,
We'll have the answer.
yeah, it might be just as easy to put it here.
But we'll know by the time we have to vote.
By next week should be.
And it included.
Well,
If they pass it.
The
right?
Board of Selectmen has to go back through, if it's an increase in the appropriation for something that's not there at all, I'm just wondering if it has to go back through everybody.
I think.
But I think either way, we have to wait for the final decision.
No, not like that, I'm just saying, no, I wouldn't figure out the cost after the final vote. It's part of the cost, but it's not reflected in the cost right now. So it would have to be taken up. Yeah, probably should have been included in the cost. I mean, it doesn't sound like it's, I mean, we're talking a couple $100,000.
I'll be honest, I'm a little concerned just because we've already gone to most of the markets out there and right now no one's really willing to do it. So it could be uninsurable.
Is that absolutely because of the top?
Just don't know, but we've gone to, I want to say 30 or 40 markets. I mean, I need to kind of go back and start to work on it again, but there's only a limited number of markets that do those sorts of things.
Right.
This one's very high risk, and I think because of the location and type of work it's being done, it's problematic. So
Does it have to do with the toxic remediation work?
that's there?
I don't think that's it. I think it's more just the fact that it's, right on the beach. The concern is that you've got a building sitting on the beach, so the insurance company is basically making a $12 million bet that a big storm's not going to come through.
While you're building.
Right, because if it does, it's basically a $12 million hit potentially to them.
Before the building's completed.
What
Did we, oh, sorry, I was just gonna say,
Yeah, we got something done last time. Yep.
We got insurance, we got
did.
risk insurance.
Let me ask you a question.
That was-
That wasn't easy either, but we did get it.
Guys, since we're all on one mic, we should have one person at a time. Jim?
But the question, I guess, is, there's the building of the building, and then there's the remediation work that's part of this $11.5 million. The remediation work's not gonna be destroyed.
But it's the value of the building, I think, is what you're saying though, right?
Yeah, that's right. I mean, we need to, Kerma won't insure the building while it's being worked on.
But not the whole building's being done.
Right.
Okay, only a portion, and that's only gonna cost, I don't know the number, you guys can probably know it, Jared, off the top of your head, but
$5 million.
$5 million bucks, the construction cost.
It was 3 and 3.5. That's true.
Right, but you're focusing on the cost of the repair versus it's the building that'll get destroyed if, right?
Right.
That's what,
Exactly.
yeah.
The valuation was
The
7.4,
building's only 3 and 3, or whatever it is.
but the valuation was 7.4.
No, we don't
That's-
have, no,
that's
no, we
both
don't,
Sides, right?
no. That's not the building. I mean, if you had to rebuild the building,
Which building? Are you talking about the whole?
the whole build, like, let's say a hurricane comes through,
Okay, yeah.
right?
Mhm.
And while it's under construction, the thing comes down, right? Now it's not just the cost of the repairs, it's the value of like replacing the
I
building.
guess the question I have is, but part of it's not gonna be touched. So they're not insuring that part where there's no construction. The builder's risk is really for the building part, not for a part that's already theirs.
But that's the problem, the problem, you're right. It would be nice if we could get a company to do that, and Kerma would agree to stay on the building, but they won't. So Kerma is gonna say, okay, you need to insure the whole building while it's under construction. It won't be us, it's someone else.
So
That's the problem.
I'm being told by Mr. Bremer that it's already in the building budget.
But we don't have a policy. Okay,
There's, I'm just
You mean
telling
there's
you.
an allocation because our insurance broker right here is telling me.
did you say,
He doesn't know what
remember a
number.
line item?
Everything's included.
I think you just said it went from 500,000 down.
I don't think there's a line
I think
item.
the quote I saw that the
Ask them for
builder,
the line item.
the
Yeah.
contractor got, I think was somewhere in the neighborhood of 500,000. The problem with that policy is it had a number of exclusions. So, that's sort of like flood and wind, for example. I think.
They were excluded. Flood and wind.
Why the hell?
Why would we need that in Penfield Pavilion during a hurricane?
I thought you said that you could find a policy for quotes you were getting were 500,000.
No, I was referring to the quote that the town got from the building contractor.
Okay, so you think it's gonna be
Oh.
higher than $500,000?
I mean, at this point, I don't know. That's,
Or you think it's
I
uninsured?
mean, I just got this
We need
news
$5
today.
million, it's uninsured.
Yeah.
So-
Yeah, I mean, it's just a question.
So if it's uninsurable,
At some point,
if it's uninsurable, we don't have to worry about it. We're gonna have a positive variance there.
Right, well,
Because we'll just self-insure.
no.
I'm not convinced that the insurance was included in the numbers, because the detail that we got from the construction manager didn't include that information, so it would have had to have been quote unquote included in the contingency, but that was already thin, and that also included, if you remember, when we had our hearing, the comment was the $100,000 for the flood study was included, but it wasn't. It was really just potentially part of the contingency,
Okay.
which was already thin. So I don't think it's a real savings. But my question to you is part of whether this building is going to be insurable. It's not clear for me in this conversation if we're talking about the insurance during construction or after or both. And my question regarding once the project's complete, is it also potentially uninsurable? Or-
No,
Okay.
that's not a problem. Kerma is fine. Once it's complete, Kerma goes back on it and it becomes part of the total property blanket. And that's why the building is insurable, because it's part of such a big property.
Right, but we've got like a 12 to 15 month project.
Right, so
It's
we've got a window. That's what we're talking about. Okay.
Yeah, it's a,
So,
Would
yeah.
the premium associated with the insurance be lower if the building were brought up to current code? and effectively higher?
Well, the flood insurance is going to be less expensive, theoretically. Actually, it's hard to say because I think the idea was it was already,
Too high.
high.
Too high.
It's coming.
That's what they're saying.
Yeah. So
Gotta be lower.
I think that, I don't.
Well,
think
the beams have to be lower.
gonna
The building's supposed to be higher. It's supposed to go both ways. Right, because they want to they want to have the water go underneath and not harm the building. The building itself is too low, or too.
But it's gotta be built on a grade of 12, right?
I'm gonna guess the answer to that is no, because otherwise, I mean, I have a FEMA compliant house, but I don't know if it's compliant to current code, but it's compliant, and that's how my policy is based, I'm sure the code has changed since it's been built, so I don't think,
Yeah.
it's been downgraded, so I think.
Yeah, there's no concern about the
Right.
before or after, it's during the construction.
Okay,
Right.
that's good.
Yeah.
At least it's a
I mean,
finite
it's-
period of
yeah.
time.
Yeah,
Right. So,
Well, can we try to maybe get an answer? I mean, couldn't we just increase the budget for insurance? Or are you gonna have an answer, how long is it gonna take you to see whether it's insurable at all?
I mean, I'm going to be working on it over the next week. I mean, obviously it's not approved yet, right? So we don't really,
You'll know tomorrow, right?
but I assume it'll get approved tomorrow. Hopefully it does, right?
well, I think it's Monday, but
Yeah.
assume it gets approved Monday.
Yeah. I mean, I'm not waiting for that, obviously. I have conversations with Kermit tomorrow and, we'll be working tomorrow.
It's not Monday, it's tomorrow.
That was the
Did they-
27th. Oh, they
It's
changed?
up to the 23rd.
Okay, who knew?
Yeah.
All right.
So I
I
should
mix it with all
I
the
should
other
have
stuff,
more
it's getting
news
too much
the
stuff.
next week or so, I think.
And to the point, I mean, you just found out about this today.
Today.
Yeah. so
Yeah.
for-
I mean, I wouldn't have mentioned it except that you asked. So
Yeah, no,
Like I
I'm
should
glad you did. It's,
I mean, I don't want to alarm anyone because these things happen and typically they get worked out. So
Yeah.
I'm not worried about it, but
I mean, I guess the critical thing is if it gets approved, then it's a matter of getting it insured before construction starts,
right.
right? Which would be this
That's the
fall.
time.
Yeah.
I think, honestly, the strategy I think now is I need to sort of really dig into the mechanics of what's happening because I don't think the markets are really understanding what.
And that was,
You're looking
yeah, and that was sort of the concern. I remember, and I asked this question to the construction manager, have they overseen a project like this on a beach, replacing a foundation on an existing building without moving it on a beach? And he said, well, not really, it's unique. So that's the whole
Right.
thing.
Insurance markets don't like unique.
Yeah.
So
They like plain Jane
Yeah.
stuff,
can I ask a question related to this? Let's say that we do have time to actually get the insurance to cover this construction period. I guess my question for this board is whether that the cost of that should be included in the operating budget for here or whether it should be included in the construction costs and those funds.
I think I
Potentially.
would say my vote would be in the project costs, but that would just be, I mean, whether that comes out of the set aside or whether bonding or whatever, it turns.
I think that's what happened last time we did it, because I did the first builder's risk on Penfield. So this is like round 2, and I believe it was included in the budget, the construction budget.
Yeah.
Correct.
And you have
And that's
a way.
pretty typical, I think, when I see building budgets, they build in those, what they call soft costs, which would be
Sure.
actually a soft cost.
And you have no way of estimating because the market is so volatile, you would.
I mean, I'd be just guessing at this point.
Okay.
I mean, like I said, I think that the number I saw was 500,000, and then the number I got as an indication was 150,000, which I was thrilled about, and I was hopeful that that was going to work out, and just found out today that the company that offered that initially, after doing more research, has said no. So I need to find out more tomorrow about what's all behind that.
He said, no, they won't bid on, they won't give a quote.
They won't offer the coverage. They're
Yep.
saying they won't offer the coverage. They may change their mind, but that was what I found out today. So
And Kermit did it the last time? Was Kermit the last time?
Kerma actually outsources it. Like in this case, they're using Star Insurance, which is a major company. It's a sort of an offshoot of AIG that does a lot of this. So Star Insurance is the one that is saying no right now.
Yeah.
But the
And they're-
project
because
was
sometimes
probably
it
more
does all their
typical
buildings.
last time.
Well, but the last time, from just a pure mechanical perspective, was a lot more volatile than it is right now. This thing is still in the ground. It's still got footings. Yes, you're digging underneath it and replacing the dirt. But the last time we picked this damn thing up and put it in a parking lot, I mean, it was a lot more volatile to a storm surge, right?
Yeah.
So you would think this compared to last time would be an easier
I would
sell.
agree. Yes, I would agree. Absolutely, exactly what I said.
The building now.
No.
No, we're just digging underneath it.
He's gonna pick it up.
We're gonna put a new beam underneath it. We're gonna dig underneath it, get all the bad stuff out.
Vacuum all the crap out of it.
Vacuum the crap out, and put new stuff in.
But how do we lower the building?
No, you're
Just change the beam.
Great.
Like, next to beam.
Just the great beams, Jim.
Yeah.
Oh, okay, so that's a different number. So 270.
This is
But
what
it's, but it appeared, it looks like it's in there, like it's in there.
That's what they're budgeting?
Yeah.
Yeah, okay. Yeah, okay.
Quote, and
Is it in the quote?
Is it?
It is.
How much is in there?
Well, it's not separated out, there are 3 line items in there for 217,000, along with testing special, and special inspections, owner contingency, and builder's risk insurance. 217,000.
And it's gonna be really hard to do a quote because you've looked at 39 markets or something like that. And you can't tell us whether this is even insurable, so it might not be.
Well, one of the things I want to do is talk to Eli, because Eli's been the person I've been dealing with on this, and ask him, does he have quotes from other sources? Because that's a
Okay.
possibility. 'Cause, no, I don't know, I wouldn't
Get
know
that
about that.
number. Yeah.
Yeah, because that may be where that number came from,
So,
which would be great. I mean, if
and
it.
just one last thing, this number can be changed along the way now because bond counsel said that as long as a number for insurance was in, or for something else.
Yeah.
It can be changed.
I think, yeah, you're right. And that's why we didn't have to change the resolution for the
That's what we
100,000.
would have to change the rest of it.
Because they said there was something in there for contingency.
There were, yes, that we had actually showed that we wanted to authorize money, including like insurance or
Yeah.
something else.
I mean, I'm not sure if there's any point in changing it because we don't have a number to change it to.
Yeah.
So we could, and, we have this money set aside, so hopefully it's insurable. Hopefully that when there is a number.
Mhm.
Assuming this passes, then, and we can get insurance, then we, may have to appropriate more, but, okay.
If it passes, I'll just say that we should start thinking about it. I would be willing to make an exception to save 1,800 people. Potentially having increases in their flood insurance.
Yeah, we had,
To increase a budget line this year for this special circumstance.
Yeah.
Well, that's the
and-
project as a whole.
Yes.
We're not, we already, we voted on this and it passed this board, so hopefully we get insurance for this thing.
Yeah.
All right.
But let's be clear here, and this is just my opinion, this should not be a reason the RTM should vote against this. If they can't rate, Frank brought up, they can't add to it, like we can, right? So this is not a good reason for the RTM tomorrow night to say, oh, I just heard last night this isn't insurable. Let's bump it all the way back to the Board of Selectmen. This board is willing to add the amount, whether it's in this line item.
I don't think it's a question of the amount of the insurance, it's whether it's insurable, right? So,
Right.
and if it's
You don't
not, and if it's not insurable, then you take the risk that during this period of time when it's under
Right.
construction and you're putting all this money in, or the 6 million, I guess, or 10, whatever it is, the differential, it's not insured.
Right.
So, but there is time. So if,
Right.
let's say this passes, there's going to be, and construction, as I understand it, is not going to start until after the summer season. That the construction manager said it's going to take months to put together the specs to even go out to bid on this stuff. So there's time.
I guess what I'm saying from a fiscal perspective,
Well, that's up,
there's no
yeah,
reason to
that's
not
not our-
vote on it tomorrow night.
that's an RTM decision. It's not, they have to evaluate that and they can hear everything that was said. So that's not
I'm
us.
just saying, I think this.
We
board-
passed it.
Yeah.
So.
I just think this board is saying that we would, from a fiscal perspective, when it's deemed insurable, we would add.
From a fiscal perspective, this is why it's good to, yeah, not rush through these things. Anyway, all right. What else? Any other key things that we?
No, I would say that covers it mostly. I mean, cyber liability was a big issue
Right.
last year.
Yeah.
This year, things have calmed down. We've got travelers back on the cyber, which is great, at a lower cost, better coverage. So that's become an issue. So that's good.
And that was, and we needed to.
Cyber would be under the liability.
Yep. They had wanted us to do some things and we complied with all of that, right? They'd wanted us to have like dual, like.
Yes,
factor
MFA
identification and, yeah.
endpoint detection, correct. All that's been done. So the town is really in good shape in terms of, cyber controls, I would say.
Okay, good.
Is any of our errors and omissions 8.24% based on claim history? We've been having claim history on the errors and omission policies that we have for the town of FairTV.
Yes. Yes.
What areas? I don't need to know.
Just generally, various lines, different areas,
Give me examples of the kind of claims.
I think I would just be
Yeah,
weary of
yeah.
saying it, just
Right.
because they could be related to a select number of people, and it may be something that would be more.
We can talk in executive session.
Yeah.
We'll be coming into executive session. I would like him to come to executive session. I'd like to understand what a good cost liability is.
Yeah, and I think, again, it would be good to have, the summaries of these things. So let's see. Okay. And we may end up with, we do have our makeup, or not we have our follow-up discussion on Monday night. So one of the things I want to do before we finish tonight is, I think there's some things we already know we have to follow up on. So if there's anything else, I don't know if I don't want to make anybody sit around all night until we go into, make Rob sit here all night until we go into executive session, but let's see what it turns out to be.
Madam Chair, to that, and
Sure.
can I ask a clarifying question? You asked about the, matching up the, what's in the budget with what's in the PAPR.
Yeah.
Coverages.
Mm-hmm.
As I'm looking at them, they align. Like you can take each one of these and line it up with what's in the PAPR and see what the deductibles and limits are.
Okay.
So is there something more that you want there?
Okay, I'll take another look at it. I think it's helpful for everybody to understand what each budget line item represents. So I think the CAFR has a general description, but I'm not sure that translates into what these premiums costs are for, in these line items. So maybe just a bridge, but I'll go back and look at it again. Okay, any other questions on Jim?
Doesn't have to be during the budget season, but at some point, these insurance coverages, deductibles, things, we get like a one-page summary of it. This is because issues come up with this board all the time when the digester happens. And we're all sitting there like, what's the deductible?
Yeah.
What's the insurance limit? If we can have that, that'd be great. And I think I ask you this question every year because obviously it'll affect cost. Has any of the assumptions on insurance, either the deductibles changed, any other thing? Because you can adjust this all the time. You can drive down costs, and maybe it's supposed to be a 10% increase, but now it's reverted down to 8. So has any of the deductible levels changed on any of the insurance from last year to this year? No. Excellent. And I think you've said that for the last couple of years, so it's pretty much stayed the same, except getting rid of the scholastic insurance. And, we've talked about some of the things.
Yeah, small changes, but nothing significant.
Nothing significant. So we're just basically, you were told to go book this as is.
Yes.
From 1 year to the next. Okay. That's it. Thank you.
All right, any other questions on insurance and claims? All right, other than risk management. Okay, and risk management, we have, Jared, when we come back to that, we do have the analysis of the internal service fund that's in our materials.
Right.
Is that's for tonight, right?
We were thinking that, yeah. I mean, we have somebody on for workers' comp.
Yeah, no, I'm not talking about in order, but do we need Caitlin for that or
No?
Okay, all right. So, okay, good. All right, so, well, thank you, Rob. Okay, so workers' comp, which is on page 88. And are there supplemental materials on this?
I think there's one page.
There is one
Okay.
page.
One page in some.
I thought I saw something come through today, but I didn't get to everything that came this afternoon.
Right after Milliman?
Yeah.
After Milliman? Okay.
Oh, well, that-
Thank
Very small. I was gonna say, it's not that big, so.
Yes, I think so.
So his follow-up would be on Monday, so he's to attend on Monday.
Yeah.
Okay.
So do you want to talk, are we going to go into executive session tonight for risk management?
I don't think so, because I'm not sure there's anything, we already talked about
Okay.
claims. So I think
Yeah.
what we really want to look at is the internal service fund and the activity, all the pieces of it, and understand kind of what's, what's in there. And we already talked about the claim, the detail of the claims, so I think that's good. Okay. So is this the attachment you were talking about? Is that it? For work?
Internal service fund?
No, for workers' comp.
Workers' compensation,
So,
This page.
that was what was, so, you had a question about long-term and short-term
Oh.
liabilities and that.
Is there any other supplemental backup for workers' comp for tonight's discussion?
No, just, we were gonna
Okay.
go over the budget and then Dan
Okay.
Coach can answer any questions there are.
All right, so Rob, thank you. All right, and Dan is,
Yeah,
remote?
Dan's remote.
All right, welcome, Dan.
Put Dan on the big screen.
Put Dan on the big screen. Okay, so for the benefit again of the public, this is on page 88 of the budget book. We're going through workers' comp. And in the backup materials, there's just a short schedule that shows the liability for workers' comp. So what's in the budget book is the current year expense, and then the total liability, which is accounted for in the internal service fund, is on page 40 of the supplemental backup. Okay, so who's going to kick this off? Is this going to be Dan or you guys?
I could fill in high level and then if Dan feels I missed anything,
Okay.
but.
And Dan is muted, I believe.
I sent them a request out.
Okay.
Dan,
I am, sorry about that.
Perfect.
so first, the only line here that's changing, and I know there was a question about the claims handling service, so I'll ask Dan to fill in on that. But the workers' compensation is increasing by 9.23%, and as I understand it, and speaking with Dan, is same thing. Claims history, we had a good year fall off and a bad year come on. Dan may be more familiar with the numbers, but that's why we're getting this 9.23% increase.
Yeah.
And
Dan,
Dan,
again, what's the reason?
we had a good year of claims experience come off and a bad year come on. So we had like a year where we only had 700,000 in claims come on. And
This year was a bad
year with
year.
like 1.2 million in claims.
So what is the methodology then? Just some sort of 5-year average or something?
Hey Dan, you're still unmuted, but it's not an actuarial analysis, but it's something.
It's an
Some,
estimate. It's an estimate, so. Mhm.
So can you
Yeah, and
explain the methodology for how you,
Well, first of all, I'm just covering for my colleague, Ralph Maliso. He supplied most of the estimates to Frank during the run-up to this back in December and January, right, Frank?
Yes, yeah, he gave me the cover sheet with the estimates, but I remember when we spoke, we kind of went over the claims experience, right?
Mhm.
And kind of what was driving the increase. Could you just go over that a little bit?
I have a different, I'm looking at something a little bit slightly different. It was an email that you sent back in early January that looked to be part of the book there. And so that number was a little bit different than what you're talking about right now.
I don't know what email you're referencing.
so we have a budget number of 1,604,400.
And it may be, Dan, that the numbers look a little bit different because I think this is allocated to other funds also.
Okay.
Yeah, so okay, so I mean, I had a document that was showing that the workers' comp was, it looked like for this budget here was almost flatlined, so that maybe was just a preliminary thing. I don't think I saw the budget book there.
I'll find in my email the data that I'm.
So should we come back to this then on Monday?
We do this on Monday?
So,
Yeah.
yeah.
Makes sense.
The workers' comp does have a WPCA component and a fire school component.
Yeah.
Yeah, that's why.
Self-sustaining budget component
Yeah,
as
and
well,
it would
right?
be, that's why it would be helpful to have the whole thing.
I thought that was in here.
Like I said, Ralph went through it with Frank through the numbers there.
Okay. Yeah, no,
Monday.
let's do it Monday. Yeah, because I remember this discussion last year and we had been trending down for quite a while. So it'd be helpful to understand the methodology as to how we came up with the current year budget number. All right. Well, we can move.
Are there questions about any of the other aspects
So,
of the workers' comp?
yeah, the other one is heart and hypertension, which which is up around 6%.
Yep. So that is what Ralph does here. He takes the numbers. He'll take the numbers for the last 4 years and average them. What they're doing there, that's what they do on the heart and hypertension side. On the workers' comp side, what he does is an estimate. He uses a couple of the I'm trying to think of not really IBNR, but the development factors for workers' comp. He uses 3 of them, and he averages them, and then looks at the 5 most developed years, and comes up with a projection or an estimate for the current year, including using the data for the current year. That's the methodology that he's used there. He provided Frank with a spreadsheet with all the numbers worked up and developed using an average of 3 different groups here. Let me just read them off to you, the folks that they're using here. He's using NCCI incurred, NCCI paid, KPMG reserved, and he's using an average of all those, developing the current year, and then using a projection for the 5 most developed years. That's how he's coming up. That's the methodology he's using. What they're doing is my understanding is on the comp side, you're actually funding for, and he's giving you an estimate for the upcoming year based on the previous years, and it's really an estimate of the current year and the previous in the 5 years.
So in other words, it sounds like we're coming up with using all these factors to come up with
Yeah, I can show
total
you
liability, and then the change in the total liability is what's being budgeted for. Is that correct? Yeah. Okay.
You have
And
an
then
ability, can I show you a spreadsheet, or is that not
Sure.
looking for that? Let me do a share here. So this is what I'm talking about here. He has taken, these are the numbers for the last number of years. This is the current year here. And so far this year, they've paid 104 reserves there. This is a total incurred, which is both paid and reserved. And these are where the developments are coming through. And so he's got a developed factor of 808 at this point. But that really is this here, these last 5 years right here. Most developed years in your book of business. So he's using those to come to a projection. We're not saying it's an IBNR, it's an estimate, and using these reserve factors here, or these development factors that are off to the side here. And on the H&H, what he does with that, you can see he came up with an estimate here. He took the last 4 years and averaged them and came up with the number. And that was what was provided to Frank. So we came up with a number where we, used the 808 as a projected liability for this year. Workers' comp, that's for the board, that was for the town side. The Board of Ed had a projection of 767,000. Some of the other charges that were in there were the workers' comp, liabilities to the second injury fund. What that is a projection of, what it is your paid losses for calendar year 2022. So they were about 1.4. We used the current rates for the state workers' comp assessments and came up with a projection with that. That's included in the number also. It's about $105,000. It's actually kind of steady with what your calendar number, I looked at your calendar number for last year and it was 1.42. So over the calendar, not fiscal year basis.
Sorry,
So
I don't mean to interrupt, but just stepping back here, I think what would be helpful to understand, because, we have this, we have these liabilities accounted for in the internal service fund. And, these are long-term liabilities. So I think what would help me at least is to understand to what extent our total liability has been calculated based on, existing claims that are going to be paid out over time versus, other assumptions that we've put in here. We've got, according to this data, we got 3.5 million of short-term liabilities, meaning paid out in the next year, 8.4 million, 8.5 roughly of long-term liabilities, which I assume is existing claims that.
So before I feel some kind of, I think I feel a disconnect on what this line is. My understanding is that this line funds current year claims.
This line should go fund the internal service fund, has to cover the total liability. So what I'm saying is, I think what I'm trying to understand, what it should be is the budget, just like pension with the ADEC, should be the number you need to get you to the ending liability. So what I'm trying to understand is how is the ending liability, start with the ending liability and understand that methodology. And then the difference between last year's ending liability and this year's projecting ending liability, I assume, should be this budget number.
I don't know how that would work because last year's ending liability is provided by it's an actuarial report that they performed.
Right.
So for FY23, we haven't done the audit, so we don't have the actuarial report yet.
Right, but we have a projection, right? But part of the projection of the ending liability includes, the existing claims that were there, plus new ones that came on, right?
I think, Dan, I think it would be helpful if, I appreciate you coming on, if we could have Ralph come on, because I think he would be able to give, to tie us two together, I think he would be able to give us maybe a more helpful explanation.
Okay.
And it might be good.
Let me just ask you a question. I mean, what we...
And it might be good if you guys produce some kind of written explanation tying out the numbers that are in there.
Right.
So,
in anticipation of the follow-up from you guys in person.
Yeah, so just to be clear, we know that we have, like, heart and hypertension is pay as you go. Workers' comp is not. We have this long-term liability. So we assume that when we're looking at our internal service fund, excuse me, and what we've got in there, that the current year budget is adequate to get us to the, total ending liability that we're projecting. So trying to connect the dots between the two and understand all that.
So my understanding, Ralph's explained it to me a number of times, is that what we do with the workers' comp budget is what we're doing, the estimate that we provide is an estimate for what we believed the liabilities for injuries in 2023, 24 are going to cost the town. That's the projection or the estimate that we give because we've been told that you're funding your claims and you want to know almost like an IBNR. What are the claims that arise in 23, 24? What's the total cost going to be? So we can fund these things in the internal services account you're talking about. That's how Ralph's putting this.
Yeah, and the only missing piece there is then, if we're doing that completely every year, that makes sense as long as there's no change in liabilities that we've calculated in every year in the past. So typically, you would revisit that because we have long-term liabilities that are already accounted for in the internal service fund. And if those change for any reason, then that has to be trued up. So I think we need to connect the dots between those two so that we understand that what we're accounting for in the current year gets us to the ending liability that we need. So we can revisit on Monday if that works.
Yeah, all I could say about this is that it follows the methodology in the past. I think that Ralph will be very helpful because I think it achieves what you're trying to do.
Yeah, that's,
and he'll provide the
because as we evaluate the internal service fund and that fund balance and everything else, we're assuming that liability in there is being trued up every year and that it's what we need to cover the claims, right? So
this
should just be the kind of the plug to get us to the ending number we need. Okay.
Yes,
all right.
yeah.
Thank you. All right.
So what are we talking about in terms of Ralph?
Monday.
Frank can connect.
I'll connect and I'll try to bridge the gap. I guess I think the numbers that we have and what you have is I think getting us to what Lori wants. I just think that
Okay.
I will try to get it communicated in a way that we can all understand.
Okay. All right. Thank you.
I'm sorry, wasn't able to.
Oh, Dan, we appreciate you being here. Thank you for pinch hitting. Thanks for coming.
Okay.
All right.
Do you have any other questions about the workers' comp? I've got, I did some research on the H&H, and I think we're going with the H&H. We're going, like you said, year to year, basically.
Yeah, no, that's okay. I think we're gonna, since we have to revisit Monday anyway, I think we're gonna move on and we'll circle back on this on Monday.
Okay. All right.
All right. Thank you.
Thank you.
Jim?
Frank, can I just ask you that for Monday, I just want to make sure I get an answer. The budget for fiscal year 24, 604,400.
What line are you looking at?
It's line 58,940 on page 88. 58,9. Page 88.
Yep.
Okay. However, you supplied a budgeted June 30th, 2024 internal service fund, and the number for workers' comp claims is 1,680,155.
That's the allocation that I'm talking about.
Okay.
It's coming in.
Sure. So you allocate some of that to WPCA and ECC as well?
Yeah.
Okay, so basically, why would the number be, so the amount in the internal service fund is the entire amount?
Yeah, that's what.
Budget amount is the less, is the.
Yeah, this is the.
Yeah.
Yeah.
So it's basically, it's not really that much of an allocation because it's like $6,000, right?
Yeah, I mean,
Yeah, I get it.
Yeah.
I want to be clear.
It's probably all taken into account. It's just, again, being that these are long-term liabilities, if we had individuals in here who maybe passed away or there was some other change in experience, it's just trying to understand that the ending liability is trued up and that's what we need. Okay. What threw me is sort of the good year falling off and the bad year coming on. It didn't.
Yeah, when Dan brought up that spreadsheet, he kind of,
Okay.
He went over those numbers and he was talking about the 4-year average. And there is a year of 853 falling off and a year of 1.2 coming on. I just may not have explained it well, but we'll get an answer.
Okay.
Some of the long-term liability, I have to admit, Mary tipped me off. Does some of that be in the accrual number? $12 million.
That's an accrual in the internal service fund.
Yeah. So there's more of the workers' comp number in there, correct? Long-term?
Yeah, that's where you.
So the true-up should happen in that line, right?
Yes.
Yeah, would true up the amount. Once you true up to see what you need, then that would be the general fund number that gets contributed over to the internal service fund, right?
Yeah. Okay.
That's all.
I guess where I'm having the disconnect is with the audit, the number has been trued up, right? So as of the end of the fiscal, we'll
talk offline.
Okay.
All right. Okay, so you want to do for Kathleen, HR operations? All right. All right, so everybody, HR operations is on page 87. And is this Peter?
Yes.
Hi, welcome. All right, so we have
Sorry, I'm on.
HR Director Kathleen Simpson and Assistant Director Peter Ritchie. Welcome.
Thank you.
Mr. Chair.
Oh, yeah.
Thanks.
We got one.
She's good?
Should stand after sitting so long, right? Thank you for what we brought Peter Ritchie along, the assistant director, and he's been great. Thank you very much. He's part of our foundation and our process. We have a labor relations specialist, an assistant director, and a HR paralegal. Thanks all of you.
Yeah.
And we're
No,
several months ago, we
Yeah.
helped, and now
what's that?
we're a team. We're a modern HR team.
Excellent.
So anyway, without further ado, Department of Human Resources is responsible for the following functions: labor relations, personnel administration, employee benefits, staff services, FOIA, and risk management. Managing these functions requires the interpretation and application of federal and state laws, collective bargaining agreements, the town charter and codes, and various other regulatory and statutory mandates affecting public employment. The department also provides advice and consultation to approximately 500 full-time town employees, 150 part-time, 175 seasonal, 500 retirees, and dozens of contract employees. We also have responsibility for 650 Board of Ed bargaining unit and exempt employees for retirement, counseling and processing, workers' compensation oversight, and all risk management functions. So that's really that's in a nutshell. And a request for the fiscal year 24 includes the new paralegal and labor relations specialist. Thank you again. Added in the current fiscal year as part of the department's reorganization to meet the needs of a modern day HR department. Since restructuring of the HR department in fiscal year 23, which was completed in January 23, the department has upgraded and implemented new policies and procedures. We got a contract with DIA, and we're waiting for the ratification of the Public Works contract, and we're right now in negotiations with PETA and the EEC, the dispatchers.
GCs.
That's where we are.
All right. Do you want to, I know that we had some advanced Q&A on some of the line items in here. Hopefully everybody got a chance to look at those. Software, fees and professional services, some of the smaller items. Anything else, Kathleen, that you want to hit on, highlights in terms of either accomplishments, goals, anything in the numbers? I thought I saw somewhere that you had implemented some new software tools. I mean, any highlights you want to talk about?
Well, we've worked more with our NeoGov. In other words, we've worked with the NeoGov we have now, which Peter, I'm going to have you go into a little bit, because he's been great about building that space and getting things with what we have.
So we're really, with your approval, we've been able to start with solidifying our team, and that's really powerful, right? That's our foundation for helping to now take the actions we need. And so now we're into we've been calling the renovation sort of stage, and it's really looking at trying to enhance the service value and the value proposition that we've been bringing to the employees and the town at large. And so from that standpoint, systems are very much an area of opportunity. It creates efficiencies, cost saving, risk mitigation, compliance opportunities, and reporting, and et cetera, et cetera. So at a minimum, as you've heard or seen possibly in the supplemental materials, Power DMS. This is a system that's an application that's currently utilized by the police. We've evaluated it. We've recognized it to be a value proposition for the town at large. So we're going to start to expand that application into our offerings, if you will, or our process. But we're evaluating some other systems as well that we've seen, we've referenced FOIA, and FOIA seems to be a very interesting, expanding area. So we're evaluating things in that space. And there's others that we're sort of testing. NeoGov, from a recruiting standpoint, offers other sorts of things beyond just recruiting component. They talk about training. Well, that's kind of an interesting area as well for us. So we're looking at new things as we start to now take the team and leverage the skills and experience that have been brought up.
The Power DMS is a program that, if I understand correctly, that enables employees to get training.
There's that
Dates,
compliance.
compliance and all those things. The police use it now.
They do.
Police use it in Bridgeport too. That's how they get a lot of their training and compliance requirements. So you're looking to employ that possibly for all town employees.
It is, and it's something actually just to expand a little bit more to reinforce its value to us as we it's both the training, which is what required training do we have, and have we ensuring that people take that training and then can recognize the compliance and the completion of that. That is absolutely part of the module. And then the second module is really also about policies. We have a lot of policies that we'd like to ensure that are compliant and current and things of that nature. And so we're working through that process. This system will also allow us to broadcast out emails in an efficient manner, or policies out in an efficient way, track the recognition or acknowledgement of those policies. We can do reporting, we can do follow-ups, we can do, any sort of things along those lines. So it really brings together all those elements that, as much as we, it'll help us be even that much more efficient with the people you help approve for the team. So leveraging that.
Great, we have a new policy coming at you soon.
Yeah.
AP, purchasing policy.
So, and that's all, so based on the, so all of these things were in last year's budget and they're again in next year's budget, but this mostly looks like maintenance fees. So do you anticipate implementing these things before year end?
Power DMS, yes.
Okay.
There is a timeline that's getting close towards this year end, but it will be, that's the goal. It'll be up and functioning as quickly as reasonable next fiscal year.
And then the NeoGov and the Test Genius, these will be next year?
Well, these are really kind of ongoing.
So they're already in place?
Yes.
Okay,
Yeah,
okay.
These
Oh,
are
good.
ongoing onboarding systems.
Got it, okay.
Or can I follow up on
Yes,
Are
please.
these self-administered? Are they employees can take the training on their own, create an account, open a password, that type of thing? For some of these training programs or no?
It's mostly more driven by us to ensure compliance with certain opportunities. It's a great point. I need to test the degree to which there might be other options there, but I can offer, our employee assistance program offers many different trainings and counselings and educational points for employees.
Is the EAP program something that HR offers independently? Is there a separate company that handles it?
Yes, that's all part of our benefits program. Okay.
My HR just instituted a self-administered training program today, actually. So all employees create their own password. They'll have self-driven courses they can take right online through HR. So that's all they need to do.
I think that the more we can get the self-service, that type of thing, and modules, I think that, that's one of our goals.
And just when, in a follow-up to that, so underneath your list, under Connecticut Conference of Municipalities, it's a member of the Drug and Alcohol Consortium, which I think it's a great initiative, obviously, in what we're living in. It says 12,600. Is that separate in addition to what the town pays to CCM, or
Separate.
so on top of CCM charges another 12,600?
I think it's more than that in the first select person's office.
It's around 30,000.
Yeah.
For select person's office.
No, right, no, I understand, but what I'm trying to figure out is there's two separate charges. So this, right, is that what you're saying? So this 12,600 is just for HR.
Yeah.
Correct.
Correct.
To be part of this consortium. And then the town pays CCM a whole separate fee to participate. Correct.
Sure.
Right, okay. I just want to understand. I think it's a great program. Westwood opened its own IOP program right directly across the street from Town Hall today, actually. So I was curious about it. Thank you.
Thank you. Mr. DeWitt?
Thank you, Madam Chair. I appreciate your description, and I never quite thought about the Board of Education and what your responsibilities are there. And this is very succinct, 650 Board of Ed bargaining units and exempt employees for retirement counseling and processing. So there is an HR department in central office that does not report to you. Is that correct?
With the Board of Ed?
Yeah.
Yes, they do not report to us.
So for bargaining unit, this is your responsibility for the contract negotiations, but the HR department in central office of Board of Ed, or yes, central office, they're responsible for the day-to-day HR affairs. Is that?
Well, their HR, we're separate with their employees, with the exception of the pension calculations and counseling. That all comes to our benefits manager. And so we do have to know their contracts and things and their pension.
Yeah.
And we get to know different people for the first time doing the counseling. So it's.
Yeah. But as you're growing this department, I'm excited about the fact that you're growing this department and wrapping policies around this. And this is really stuff I think we've needed for a long time. Those policies all flow down to the Board of Ed through their HR department, correct? So, I mean, I guess what I'm trying to say is this. I hope that you're not doing all this good work and the Board of Ed is not benefiting from it.
Well, we do share. We're going to share our policies and what we have. I think that a lot of them do. I think that's one of the things that we're looking at as far as our, getting our, basically like Peter talked about. Right now we're looking at, okay, we've got our foundation here. And now we have to see what kind of things now we're going to be doing to, kind of renovate. And innovation will come the next stage. Right now we need to kind of renovate, get things going, get what we can do going in Board of Ed and what policies. Do some of them. They have obviously some of their own because it is a different space involving with education and students and that type of thing. Yeah. But yeah, I think the more we can share and have it universal, the better.
I mean, basic employee code of conduct and stuff like that. I feel like that should be like with you guys flowing that down. The stuff that's specific to Board of Ed that doesn't have anything to do. I mean, I get it, but I just hope that that's the way we're framing this out. That at an employee level, this is your responsibility, and then at a Board of Ed, very specific stuff, it's their level. So,
just to dovetail on Mr. DeWitt's question, Kathleen, so the bargaining units in the Board of Ed, you negotiate their contract while you're part of it.
No, I don't. We and I forgive me if I miss my statement about knowing their contracts. It's for the pension.
I got you.
We'd love to know that.
Sorry.
So no, I don't want another bargaining.
Yeah, right.
You have enough, right?
Yeah. No, I'm with you there.
No, I think to your point though, things like code of conduct, conflicts of interest, those
Obviously,
sort of umbrella. Yeah.
That's a very good point.
Yeah.
Yeah. So thank you. That's it for me. Thank you.
Mr. Curley?
Yep. I apologize. I'm not sure if I missed this, but I'm looking at the last page of our backup tonight, page 72. It's a flat number year over year, but there's a breakout of professional fees. Most of it's self-explanatory, but the $30,000 number, which is roughly half of the 65, can you just elaborate on what that is?
The professional, with the 30,000, that's something we have to have there in case, for instance, we may have a conflict of interest with an investigation that might require getting an outside party to do that. So it could be, not that we're anticipating that, but just in case. Mm-hmm. It could also be something where we may need, again, some sort of recruiting tool, like, that we got, what the tool that got me, right, the SJR, but that could be that. So those are the type of things, just we want to make sure we have that money. And now that we have, again, more of a actual HR department.
Professional HR department.
We thought that we could probably do more with less in that area. But we don't want to get rid of it altogether because, there could be some unforeseen things that happen.
Was that, So this was 65,000 last year, but was it the same composition?
Yeah.
It was, okay, all right, because I thought last year we had a number in there for Kronos somewhere along the way as well.
Kronos was so yes, you reduced, I believe you reduced the HR budget by the amount that was in there for Kronos, but there's a reappropriation that's it.
There was a double counting for Kronos, but I thought there was still an amount in there and I just couldn't figure out what line it was.
The double counting was because we had money reappropriated for implementation, and then in the budget, we had money for implementation. So that was.
We had money for implementation, which was double counted because there was a reappropriation, but I also thought we had money for license fees for Kronos, which we obviously have not put in. And that's why I was sort of I thought maybe that was the equivalent of this $30,000.
No, yeah, this is this is exactly what you guys reduced and what was passed last year. It's the same carry forward. There's nothing thrown us in.
All right.
I'm looking at the cuts from last year. There was no cut for fees and professional services.
No, you're talking about IT.
Oh, IT.
Yeah, IT.
Okay.
IT.
Yeah, I didn't know where it was. I thought that because I remember we went round and round trying to understand. There was there was an amount for Kronos that was going to be carried over for implementation, but then I thought there was also an ongoing license fee. Or maybe it was an implementation, it was like the clocks or whatever.
Yeah.
And then there was a license fee. And obviously that's not in this year's number. So I was just trying to figure out where it is in last year's numbers and where the disconnect was. That's why I thought it might have been in fees and professional services. But
I'll go back and, but that, I'm pretty sure.
I mean, I'm okay with the 30,000. I think, things are going to come up. And as you said, with investigations or whatever, I think that's fine. I was just trying to, it's just helpful when we have these, if there's comparatives, that's all.
Last year's fiscal first selectman budget, 71,150 in IT. And it was reduced by $35,000 to be 36,150.
Yeah. But we still had okay. All right.
It was related to, I remember it was related because I remember you wanted to see to make sure the quote was still active, and I remember it all happened.
Right. Yep. And that's put on hold now, right?
Correct.
Okay. I know Jim Walsh was really anxious to see that go in, but it's not. Okay. Ms. Marmion?
Systems and FOIA, and I know you're inundated with FOIA requests and it's very time consuming. Is that system for kind of getting rid of the manpower and making it more systematic, is that in this budget? Or are you looking into a way to?
I'm looking at things because it's not that I'm never getting rid of the manpower, but just trying to think ways like, for instance, to redact things and that type of kind of cut through that.
Right.
Otherwise, you're color all the time, trying to get through things and trying to get,
So maybe an automated redaction processing or something.
And we have, our HR paralegal's really super technologically skilled and she can do a lot of that because she also, but
Paralegal, right?
yes, exactly. But she also, some of these things that might make it more streamlined and easier and things out faster for the public, which is very important.
So you're not talking about a system in terms of software, you're talking about just making it more efficient in terms of how you use the manpower?
I mean, there's not a tool in here. There's not a tool in this, but okay, look at that.
No,
It could help if I could fill in, the thought was that they have the money for power DMS, they know they're gonna need this money, and that the money that's been reappropriated for Kronos, the thought of that would be they're continuing to evaluate. And, instead of using that for Kronos, if they wanted to use that money for the FOIA request, they could, this software, then they could use it instead of doing that because these things are more of a priority.
Thank you.
Mr. They were charging more for FOI requests for research time and things like that, or can?
We can, yes. It's the fees are now we have it up on our website, so we can, and we have.
Is that an hourly fee?
Yes.
Perfect. That's awesome.
So they're all up on the website.
I like fee income, so do whatever you got to do up to the legal limits of the law per hour.
It's been helpful to, I
Can we
think, for
get
the
a permit
requester.
to-
I think that's phenomenal.
Other questions? Mr. Casson.
I just want to say, I mean, I think we've all been here long enough to see the difference in the HR department. It's, in my opinion, it's very impressive. I work for a corporation that, as we were talking about earlier, and a lot of what you've implemented. I'm not sure I totally understand the NeoGov thing, so maybe I'll call you separately to get some a bit more of a grasp on it, or our DMS. But a lot of the professional programs that have been instituted is, in my mind, it's almost like what a corporation would do, really is, and it's very impressive. Really, really, congratulations. Peter, you're no, I'll put you in. I know, it's Kathleen. I know her.
Thank you very much.
Jim?
So is there, do you have a revenue line then for that money that comes in for the,
FOIA?
for the FOIA requests?
Not on this, right, Frank? FOIA?
It's a miscellaneous.
Miscellaneous, okay.
There's a miscellaneous revenue line.
Under human resources?
I don't believe so.
Isn't.
Is it in the general
What would
budget,
that be in
Jared?
It
revenue?
may just be under finance. Have to double check. You know, we started charging for it. It's not gonna be a ton of money.
What do you mean? That's what I'm trying to figure out. What do you? What?
So to start, it's not gonna be a lot of money. Which is why, you know, we didn't really, we didn't really put, you know, we've had we didn't.
Okay, we gotta, guys, one at a time. We're all on the same mic.
Change our added research fees, like how much is that gonna add up to on a yearly basis based on, I presume $20,000, you know? I presume that number's gonna.
This is the first year, so we'll see, you know, we'll have to see.
So we go in with 0 and then we see how we do.
Well, we're finding that when we add, sometimes we tell what the fee's gonna be, say no, thank you. That's what we're finding a lot too, so we're seeing that too, so we're not quite sure.
Back on the manpower.
So your expense might go down.
I don't know yet, it's still a mystery, it is rather new, but, more on that.
May I ask, do other towns typically charge for
Yeah.
these requests? So
Yeah.
this is, you looked at what other towns were doing?
Yes, and I think that Bridgeport, I know Bridgeport does, I took I know that Easton, I went through a bunch of the different charging fees, so, and the state charges as well. It's statutorily. Thank you.
So Jared, is this line in finance called FOI income tax information? There's a line there for 300, what is it?
What's the?
$350.
42150 under your budget.
$350, Jared.
I don't think that's it, but.
All right, why don't you get back to us on this? Yeah, I guess I'm just gonna say something a little different. I mean, I think it's fine that we charge a reasonable amount, but I'm not sure I love the idea that we discourage people. I mean, the reason we found out about the fill pile in this town is because we had a ambitious resident who asked for information, and I think that there's a downside too. I think so. I think it's fine if we charge customary fees, but I'm not wild about the idea of trying to discourage residents from filing FOIA requests, because we've got a history here that I think it did us a lot of good.
I can't agree more with you. I totally believe in transparency, and we don't charge for everybody. There's exceptions.
Right.
For instance, and it's not like you flat out charge. I mean,
if somebody wants thousands of pages of documents, that's one thing, right?
They can also come and inspect. They can also, there's a $20 scanning fee. They can come with a scanning thing and scan the records, which is reasonable. And if they're indigent or have financial, you can do a financial affidavit. So it's not that we're trying to discourage. It's just that we get some requests for like a lot of heavy duty research, and it's not for someone who's trying to do the good of the town's best interest, to their own profit or whatever. And that's fine. But we want to make sure, and again, it's not discouraging, but we can't have our staff all day long doing research and when they're not getting to other things. And this way it limits people from asking for everything under the sun and being more focused on what they really need. So I
yeah, no, that makes sense.
I didn't want, that's a very.
So it's a way to make sure that the requests are tailored appropriately, right?
Exactly.
Yeah, that makes sense. Okay. All right, any other questions? in this
The
budget
operational budget or the whole budget?
on the HR operations.
All right.
Thank
Thank
you.
you very much. Thank you, Rick.
Thank you.
Thank you.
Thank you. Oh, and before you go, I just want to say as well, Mr. Testani made a comment. I really, my personal opinion, I think the organization you put together makes a lot of sense. We had a proposal before us at the end of last year that we didn't approve, and you've restructured the department differently. It's good to see a labor relations specialist.
Yeah.
It's good to see a paralegal. This makes a lot of sense, and good luck. I know you've got a lot on your plate, but it's great to have the team here. And
Thank you for staying.
Well, I want to thank the board as well. It was really important, and the help and the input, because
Yeah.
it was not an easy thing to get through, but it really worked out well.
Yeah.
We have a really good team, and I want to keep them all there.
that's
too.
the key to life, having the right team, right? Thank you again.
Thank you.
Okay. Thank you.
Thank you.
Okay. All right. So let's see. So we are, I guess, down to risk management, right?
Unemployment.
Did we go?
Risk management is part of the HR budget. Do you want to do that now?
Oh,
Yeah, we're still in HR.
Want to do risk management and internal service fund? That's
Well, let's see, is anybody waiting?
I think that-
Bill Hurley?
he's going to come on Monday. He's going to come back.
Okay, all right.
So we got debt service and fund balance.
Okay, so we have unemployment. Do we need Kathleen for that?
I don't think so.
Okay, unemployment, risk management, debt service, and fund balance. So, why don't we just keep going down the line? We can do risk management, which is on page 87, which is a zero budget, but we're going to talk about that in the context of the internal service fund. So I know that you provided some supplemental backup. See if I can get to the page.
It's page 2 and page 3. The internal service fund
Got it.
projections, and then page 4. We reference the actuarial analysis, the whole analysis, which is over 100 pages, and I'll just go by going from page 1. I'm just kidding with you. So page 4 is just the first page of that, which is the summary page. To be honest, unless.
Wait, where are you now?
I'm on page of the supplemental backup, page 4.
Page 4, which says Connecticut
Interlocal
Okay.
risk management agency.
Okay.
Yeah. So that's the actuarial report that we had Kerma run to see kind of to the point that you were getting at with the workers' comp. What is the accrual to be, and what do we kind of need to fund for current year claims? But I think it would be good to go through the FY23 projected first, and pull that to the 24, and then talk about that actuarial report.
So one of the things that, I'm not sure how they do this, but general liability, law enforcement liability, all this stuff, maybe not auto, but we had Attorney Baldwin spend quite a bit of time with us the other night, and he gave us his estimates. So what's the disconnect here?
They look at.
Because he was basing it on the inventory of cases that the town has.
The inventory of cases that the town has, yes, which would be the case reserve number in column 4. There's also this undiscounted forecasted loss of 1.2 million in column 9. That's claims that haven't happened yet, that we would expect to have happened in FY24, and then have to pay out for those. So that's just that's what they actually, using the claims history that they have for our lap policy, which is what their risk management line pertains to. That's what they calculate would have in per year claims is 2 million. That we'd have to pay.
So a lot of a lot of the process that we've used in the past is gonna stay in place where, you know, Attorney Baldwin's gonna continue and we'll meet with them, Caitlin, meet with Perma. And that's all still gonna happen. What's different is we're kind of more professionalizing like the methodology similar to we have the health insurance part of the internal service fund. And we have the workers' comp part of the internal, and those are all done through our consultant. And so we're moving toward the same thing in this by working with Perma and working with their actuaries to come up with these estimates in light of the conversation last year about how we arrive at these numbers. So, but the substance of those meetings that went on with Attorney Baldwin, those are still going to happen, and that's going to be that, but that'll be part of the overall process and the methodology.
So, but just so we all understand this, so if we look at the internal service fund activity, so on page 2 of the supplemental backup, it looks like we are projecting general liability claims of $358,000 be paid out this year. That's paid, not incurred. So that's not the amount that we need as the ending liability, but that's just the amount to be paid. So I'm really struggling to understand how we get from that to $1.2 million, or even how does this page 4, how is this being used to come up with a risk management number? I guess is my question, because we budgeted 0. And what is this telling us? And how was it considered in the budget? That makes sense.
Well, within that risk management line, that's why I suggested that we go through kind of the dynamics of what we're projecting for FY23, because we're projecting a deficit of $834,000 because we didn't contribute in risk management. There's some workers' compensation or, the workers' compensation and the risk management, the liability and auto are two separate pieces. So we know that for the accrual, just based on what we have,
I mean, just stepping back, and let me so last year at this time, we were projecting that we would end the year with, I guess, a fund balance in the risk management fund of $6 million, right? And we ended up spot on $6 million.
The internal service fund.
In the internal service fund, right? Which is where this money goes into and where the claims get paid, right? So now, so we cut the budget. We didn't fund anything for risk management, and so we assumed by doing that that fund balance would come down by about $850,000 or so, right? So it looks like, based on what you've given us here in the internal service fund analysis, that it's not going to come down quite that much. We did better, right? It's gonna we're projecting.
We did better by 300.
Okay, but in total, right? So
Total.
so I'm just looking at in total. So we didn't deplete the internal service fund balance as much as we thought we might. We did a little bit better overall. So the internal service fund does health insurance, workers' comp, general liability.
Correct.
3 of them. We did better in total. So now you're projecting. Actually, this is going to 20. So for the end of 20, no, so, okay, so.
For the end of 23, we're projecting 5.5 million.
5.5 million, okay, so, and that that number, we would have expected, had everything else come true, that would have been a little bit lower fund balance because we budgeted 0 last year. So we did a little bit better overall.
Yes.
Okay,
Where's the 5 million?
it's right here.
Exactly the same.
557.
5572831.
Where's the Lori? I'm sorry.
It's right here, Jim. The 5572.
5.
That was the projected fund balance.
Sorry.
Can everybody, hey, I just want to, guys, we're all on the same mic, so that nobody in the public, it's going to be confusing. So just one at a time. So, so Frank, just, so I understand what you, and we had the same analysis last year. So we started out with 6 million. We're going to end this year at 5,572,831. So we won't do as badly, I guess, as we thought we would. And what we're doing, and the reason we end up at the same amount at the end of 24 is you're budgeting, or you're budgeting in order to kind of keep the fund balance flat, right?
Correct.
Okay. So I guess the first question is, so the reason we did a little better in the internal service fund overall was because of the health insurance component, correct?
Correct, yeah.
Okay. And again, this activity in here, just for anyone who's following along, this reflects kind of the cash activity in and out, not necessarily changes in liabilities, right? Or actually, it should represent changes in liabilities because the revenue should be the amount that's going into the internal service fund to fund changes in liabilities. But anyway, okay, so we have this, that this tells us now that based on this budget, you're projecting to end up with a fund balance of 5,572,000 after not putting anything in risk management for 2 years in a row.
No, this is assuming that we would put in 490,000 into risk management.
But we have a budget of 0.
Right, that's the disconnect.
Yes, okay, so, that is because there was a budget of 0. And in looking at, some favorability that we're gonna have potentially in, investment income, we look to potentially options, that we could have. And in looking at the internal service fund and having, we had this actuarial report done in November. We just got it recently, and from that, we thought that we could increase the contribution from risk management. That's where they're at 490,000.
Okay.
If you didn't contribute the 490,000, then you would actually, we would expect that you would incur another.
Okay, if we left it at 0, the fund balance would be basically
5 million.
5 million, which is what we thought it was going to get to at the end of this fiscal year, just based on not funding it last year. Okay,
Sure.
gotcha. All right. So that's, does everybody?
You're basically mitigating the upside on the insurance.
Okay.
To do that.
All right. So.
For all that purpose.
Okay, so I just wanted to make sure everyone understood that. I still don't understand the second analysis, but does anybody have any question on the internal service fund case, Mr. Crowley?
Yeah, just following along, and this discussion is consistent with my recollection from last year when we walked through this. But last year, if I remember correctly, there was $800 and some odd thousand that was going to show up on risk management funds claim.
850, yep.
850.
Yeah.
58920. And in that analysis last year, that 850 showed up in this line item other, that the revenue line, that this year is reflecting 490. So I guess I understand the point that you're making, that you don't need to budget the 490 on this line this year because you've got some upside on this interest income.
Yeah. No,
I guess Mike
say this year, are you talking about FY 23?
24.
Well, I guess I would put that back to
I think we're
you.
talking you would budget it because you'll budget for the interest income and budget for the risk management.
Right, that's my point. If we're expecting to have a $490,000 contribution to this in order to keep this flat in the fund, I would have expected that 490 to show up here, and then another 490 on the interest revenue line. A few acres,
So what Frank was saying before was that so that was our proposal originally, that there was no funding for risk management in the budget.
Mm-hmm.
Since then, and since we published the budget book, we have gotten more information from from PERMA and their actuaries, and also have a better grasp on what the investment income is going to be. So now, I guess you could look at this as a recommendation.
Yeah, to gross up revenue and gross up expense. Okay.
Okay. So I guess then that begs the question, if we thought we were going to be at $5 million at the end of last year, but we had a favorable, instead of an $800,000 drag, we only had 300,000 and change, right? So I guess the question is, do we need to put that 490 in here? Do we want to end at 5.5 million, or is 5 million the right number?
So last year, it's a guess. And
I mean, I've been
last
on this board where the internal service fund on the town side medical has gone down $1.5 million to the negatives in one fell swoop.
Yep.
I mean, so I don't think that we can presume that we're just going to every year be favorable by 100,000.
And I'm not suggesting
Yeah,
that
so
we would.
and that's why I was against this whole thing last year. We had a process, we were following it. I didn't know how they were going to budget this year, because really the way it happened last year was certain people on this body decided there was too much money in the internal service fund.
Yeah.
Well, I was one of those people,
Okay. And that's fine.
No,
But there was no methodology. So
no,
really,
I think
zero, I think was, for probably to start this year, was what does the Board of Finance want to do with this?
No, hang on. This is important.
Yeah.
Listen, we spent a lot of time on this last year.
Yeah.
And I think I was clear that wasn't supposed to be a precedent, that we should have a policy. And the Fund Balance Committee, I thought, was going to meet and start talking about a policy.
I'm in the minority. I'm not the chairman. I don't decide anything.
I'm just saying that's where you get the consistency in the policy. If we should still, because the question is, do we need a fund balance of $5.5 million? You know, do we need a fund balance of 2 million or 3 million or 10 million? I think that was the point, that at some point that has to be decided on, so that we're not just, willy-nilly funding this based on trying to get to some bottom line, and that we're consistent. But, the way I look at it, I'm glad we didn't put 850,000 in last year, because we obviously didn't need it. Should we put, if we have some upside and interest income, and do we want to put $490,000 in? That's a reasonable proposal. We should talk about it. But, part of the question becomes, how much fund balance do you want to be carrying in this fund?
So if I could just comment on that, and forgive me, because, Laura, you have a lot more experience in the accounting world, accounting things that you explain very well. So for the health insurance, because I looked at it and I said, okay, last year we said there should be a policy. I don't know what's happening with this board, but I just decided to look at it by myself. In talking to the health insurance, right, because we are self-insured with that, they recommended anywhere between 15 to 20% of the current active gross year costs as a contingency amount for health insurance would be good. So that would be about 2.89 million out of the 5.72 million. The remaining, so on that point, we're good on the health insurance side, right? 5.5, if we end up with 5 million and we need about 3 million for health insurance, we're okay. Now that leaves you about $2 million, essentially as a contingency, or as a fund balance for risk management and workers' compensation. The report that we ran to get from the
To be clear, a contingency above and beyond what we've already accrued for, right? Because we've got a full accrual covered for workers' comp. We've got a full accrual for general liability, so the
full accrual
fund
for
balance
general liability, I would disagree, because that's why I suggested the 490,000. Because if you take case reserves in column 4 of 1.7 million, you take the undiscounted forecasted loss of 4.2 million, you get around 2.9 million. And
that's as opposed to what Mr. Baldwin told us, which was about 2.4, right?
Yeah.
Okay.
I mean, they're different estimates, right? Like, they're looking at a lot of claims data. He's kind of looking at what's out there. And so they'll be a little bit different. But the point being is that my job is to tell you
No, but that makes, so basically we heard roughly 2.4 and this would suggest 2.9 undiscounted, which I'm not sure I would go into undiscounted, but anyway. So undiscounted 2.9. So your extra $500,000 would get us to
What you
this
need
2.9.
on the accrual at the accrual.
Right.
And to fund the current year.
Yeah, what you needed for the ending accrual, right?
Yeah,
Gotcha.
exactly.
Okay.
Yes.
Okay. So that would be, but I guess the question is, yeah, and see, Frank, and we can take it offline if we need to, but this is why we have to understand what's in the beginning liability. Because the 2.9 is, I think we're mixing up fund balance and other things. So how much is in the existing internal service fund liability for general liability right now?
As of FY22, for general liability would be 2.26 million, which is that for the page number on the back.
Okay.
100%. Yeah, so that's the.
Okay, so the numbers close. So your extra 490 would be to,
Difference between 2.7 and 2.9.
yeah, but you also paid during the year. So you started out at year end with 2.2 million.
Correct.
We paid out 400,000 in 358,000 in general liability claims.
And then there's the other little liability line that you have to account for. The sorry, I'm flipping. I gave out my extra copy, so I'm using.
Okay.
458,000 is what you paid out in town property.
Town property.
General
Okay.
liability.
So basically, this 490 would replenish kind of what we paid out.
Yeah, I mean, essentially.
Okay.
As it works out.
Yeah. Okay.
That was in the calculation. We're
That's not the reason.
Yeah.
Yeah, it's not
It just happens to work out.
Yeah, it's just,
Yeah,
yeah.
it happens to work. Like I said, when I'm looking at.
Well, that's what I'm trying to get to is what we have to focus on is what is the ending liability we should have in here. And that's why last year's beginning balance, what did we pay? And what do we need at the end? That equals what we should accrue for, right? So this would seem to, on that one line item, leave us a little bit short, but that's just on that. So that we've got the three pieces. Okay. And by the way, if it leaves us a little bit short, that just means, fund balance might be a little bit less, which is, we've got to.
And if it leaves us, this is a year, if it leaves us a little bit short, then we come back next year, we go through the same process next year with
Right.
the actuary.
Okay.
And they would be trued up next year.
Yeah. I mean, I think what would be, I don't know, the way I think about it is, again, beginning balance minus what we paid is sort of what we have in there. Then it's what do we need at the end, which maybe is this Kerma projection, and the difference is what we need to budget, right?
Yeah, and that's what I'm saying. We're budgeting.
Okay, the 490.
Yeah.
Okay, because I think the 490 would leave you short of what you're saying you need for the ending uncounted balance, but that's okay.
Like I said, it's.
I'm not sure I would go undiscounted on long-term liabilities anyway, but I hear you. Okay. So your recommendation right now is 490. I think if you had that same sort of calculation for the three pieces, it would be sort of clear. If we budget this, then we're projecting our ending accrual would be this minus what, and then you'd add them up, and the difference between that and the ending fund balance would be our cushion, right? Okay. So just so everybody understands, so that the 1.7 and the 1.2, this is our 2.9, and this contrasts to what Mr. Baldwin told us, which was, I think, about 2.4 of everything he knows. And I think that the 2.4 included an estimate of small stuff that kind of comes up and gets paid in the same year. Okay.
But again, to Frank's point, there are different calculations.
I understand.
We have an actuary that's doing the calculations now.
I understand. Yeah.
And that's new.
That's new. That's brand
Yeah.
new.
This year. Okay.
Yeah, that's good.
And the 490, really a cliff. We're filling in, right? Because we're at 0. This is all fresh money.
Yeah, we're
Put in.
building.
Yeah.
Yeah.
Okay.
Okay.
And that's something we talked about last year. Here we are.
I mean, I don't think it's a cliff, but
It's totally a cliff. We reduced it from a normal amount to 0.
We
and
did.
Now we're at 490. I mean, it's a cliff.
Right.
It's a self-created cliff. We talk about cliffs all the time.
No.
And I think there's a tendency to say, when you don't want to do something, oh, that's a cliff. When you want to do something and you want to reduce something to 0, and this is my opinion as a board member,
Mhm.
there was a bunch of cuts last year that were made that pretty much equaled restoring a $2.5 million Board of Ed cut by the first selectman and the Board of Selectmen. And now, turns out that $2.5 million restoration turned into a $2 million surplus this year that they spent.
even more of a surplus on the
Yeah.
downside. But I hear you. Budgeting
Yeah,
is imprecise. We get it. Yeah.
But part of that is when we went, and I argued this last year, that we'd be creating a cliff. And we did, because we have 0 in there, and now we're having to go up to, if we decide to do it, go to 490.
Well, I think the reason it's being proposed is we have some upside in interest income, potentially quite a lot that we haven't accounted for. But regardless, listen, at the end of the day, to me, and where I came from last year, was we had a fund balance that vastly exceeded any amount of volatility we could possibly have in this fund. And I think the results from this past year prove that out. We had even less volatility. In fact, if we didn't put a dime in here, we'd be about where we thought we would be. So, we wanted to take that fund. We thought we could afford to take that fund balance down a little bit last year, and we did.
To what number, though? Well, like, how did we determine what number was a good number to reduce?
Well,
it was basically, why don't we take the whole thing out? It wasn't like an analysis. At least now we have an analysis.
it was 7 times the current year study.
So what is the number you're saying it should be?
No,
Should it be 5 times? Should it be 3 times? Should it be 1 time? What's the number? We never talked about that. There was no number. It was basically, this is my opinion.
Yeah.
We need to get a number to restore the Board of Ed thing, and we could use $800,000.
With all due respect, may I, Madam Chair?
Yes, you may.
I didn't tie that to the Board of Ed piece of the budget at all. In fact, if anything, I would say that the better comparison is the $850,000 that came out of this line last year versus the $800,000 that went back into paving to actually fund the plan that the town paid for and wanted to implement. So I think that's the better comparison.
Whatever it is.
But the chairwoman is correct that last year we looked at this number and it looked like it was 7 times coverage on the fund balance versus what the annual potential draw was. The $850,000 that was the projection for the draw turned into $350,000.
But I guess what I say, Craig, is what is the number then? What was the expert advice that you said 7 times is too much?
We looked. Well, I would
seems to be a good number.
I'll answer that. We look back over the history of this fund since it had just covered the town, since the Board of Ed exited the internal service fund and went on the state plan.
Yeah.
We looked at the history of this fund and there was never anything remotely like 7 times.
Okay.
It was a tiny fraction for the past 5 years.
Okay.
So we looked at that and we said, everything in here would have to go horribly awry all at once to even begin to approach that kind of drawn fund balance. So, and by the way, at the time, we had 8.5% inflation and we were earning 0 on our money. So it really didn't make sense to taxpayers to put away money that we didn't think we needed. That was the rationale, whether anybody agrees with it or not. That was it. So now we're here and, we're saying, the town budgeted 0 initially. Now we're saying we want to put 490 in. We can do that. We cannot do that. That's the recommendation. So all I'm trying to get to, which is the same place I tried to get to last year, is the facts. What are ending liabilities supposed to be, or what do we think they're going to be? I appreciate this new analysis here. I will say in my experience, I usually haven't seen this done this way. Typically, when I've seen liability claims get calculated, it's usually based on, the sort of thing that we do with Mr. Baldwin, which is to say, what's out there, what do we know of, what's our estimate of what's going to be paid.
And this is.
And this is
it's
fine.
baked into it.
And this is totally fine, okay, but we have this number here. So I think the easiest way to look at it is to say this internal service fund has the three pieces. What do the ending liabilities need to be? What are they before accrual? How much do we need to put into the budget? And that's what the budget should be. So if I were just looking at this line item alone, it wouldn't be 450,000 or 490,000, because if we started at 2.2 and we paid out 400,000, that gets us to 1.8, and you're saying we need 2.9. That's $1.1 million. So that's why I'm saying, just if we put the numbers on the page.
Are you talking about it, so you're assuming that you draw down the accrual, right? Saying if we were at accrued 2.2 and we paid out
right
for our accrued 0.8.
I'm just saying, if that's the way you were going to do it, I'm not saying that we need to be accruing 2.9, but it seems to me, based on the numbers you provided, we started out with a liability of an accrual of 2.2. We paid out 458,000, which leaves us with 1.8. If we need 2.9 at the end, if that's what this thing is telling us, and I'm not convinced we need 2.9, that's a $1.1 million delta that you would have to put into that fund to get to 1.9.
I disagree. I look at it I'm just looking at it a more simpler way, and maybe I'm looking at it wrong. I'm looking at, if I go to the FY24 page and write, I'm assuming that what we're going to put in town department premiums of 1.68 and workers' comp is going to come out as an expense of 1.68 and get, probably accrued or whatever. And then on general liability claims, if I don't put 490,000 in there, or of the 12 million, sorry, we go down to the accrual row and we see 12.049 million. That's just what the balance was as of FY22, because we haven't closed FY23 yet. As of FY22, the amounts there are, sorry.
Yeah, I just, here's.
I'm sorry.
Okay.
There's 2.2 million, of that 12.049 million, there's 2.2 million in general liability, and workers' comp, there's 9.8 million. And like I said, I'm assuming that through FY24, that's going to be the same, because whatever's coming in as revenue is coming out. Of that 2.2 million, I'm saying should be, we would need to fund in any given year up to 1.2 million in undiscounted forecasted loss, things that happen in fiscal 24 and get paid out of the same year.
Mm-hmm.
And what this is saying is the accrual would actually need to be
0.9
on the actuary. So the accrual at the end of the year would be 1.7. I'm just saying what goes into that fund, the accrual plus what you need to put in for what you're going to incur and pay out in the same year should be 2.9 million. The accrual that Caitlin has is 2.2 million. Column 4 for the case reserve says 1.77 million, but we're putting it less to pay out current claims of 490. We're not putting anything, and this is saying that we would have to put 1.2 million in. So,
yeah, it's saying you have to put, and the reason the numbers are different is because we're getting caught up looking at the current year activity versus what we need. Like, well, what the internal service fund should have is the ending liability that we need today. So I just, and it's hard because, again, we've got the three pieces here.
So
we haven't broken them out, but I don't know, does
I
anybody?
can share the methodology with you.
So
Maybe.
let me just, so this is only for, and just to be clear, this is only for general liability, right? This analysis. So we've already been doing this for workers' comp. We've already been doing this for health insurance. So we've just added the general liability analysis to it.
Correct, yes.
All right. And the workers' comp, we have, that is also a long-term liability, as this one is. Workers' comp is discounted, I assume.
Yeah.
Health insurance is not, because that gets paid out currently.
Correct.
Right? Okay. So, okay. I mean, I would just say, you know, I don't mind putting more money into the risk management account, but I think it would be helpful to lay it out so that it would just be clear what we end up with versus, you know, vis-a-vis these ending liabilities.
Based off this conversation, there's probably a better way I could lay it out.
No, listen, I'm glad we did this. This is, you know, this is good, but I just, it's a little confusing. But right now, the recommendation on the table is to change the budget from 0 to 490,000.
Correct.
Okay. And that would get us to not quite the 2.9 million that's here, but closer to the 2.9 million.
Yes.
Right.
That's not the recommendation of the Board of Selectmen though, correct? This is your,
No.
right. This was not, I just want to make sure, this was not voted on by the Board of Selectmen.
No.
This is just a recommendation to us.
Based on more current information.
Yep. Yep, okay.
All right, so the one thing, and maybe we can, and maybe I'll reach out offline, Frank, but maybe what we could do just before we, because it would be good for the board to revisit this again, I think on Monday. And I'll reach out just so that we can see the three pieces. You know, recommended ending liability. What is going to be in the internal service fund, and then where this budget brings us, and then how much fund balance. That'd be good. Okay. All right. Anything else on risk management? All right. Unemployment compensation, 3150. So that's on page 125. Yeah, page 125, it's, the budget is flat from last year, 255,000. Is this, are we, did this budget, is this actually coming to pass, last year's number?
I believe it is actually lower than, I think I could. No, it's lower. I just want to give it a 1 second.
Okay.
So this year, current year, last year we ended at 148. This year we're at 50,000.
50,000?
Yeah.
50.
It's for activity.
Is that a full year projection?
No.
So that's what, through half the year?
Yeah.
Okay.
That's through half the year.
And would it be reasonable to think 100,000 then?
For the end of the year.
Yeah.
I'll follow up with Caitlin and see
Okay.
what she had for her quarter. Because she may have some information that I don't have.
Okay. All right, anybody else have questions on unemployment compensation? Okay. All right,
Oh, I mean, I'd just like to say that we have there's no planned changes, major changes in the employment of letting people go that we know of. So like during VERIP or something like that, where we did potentially have situations like that.
we had VERIP and then we had COVID, right?
Yeah,
COVID.
yeah.
No, yeah, so.
And the year before was what, one
Things,
point eight, yeah?
things have kind of returned to normal.
Mm-hmm.
So, all right.
Yeah, it was reduced from 350,000 to 250,000 last year.
Yeah.
It's your flat.
Okay.
But the real, but you said the real actual of 22 was 148, yeah?
Real actual 22 was 148.
Yeah, that's in the book.
It's in the book.
Yeah. Potentially. Oh, no, it's 154. Oh, with fees for veteran services, sorry, yeah.
Yeah, okay. All right, so we'll get an update on that one. Okay.
Yeah. Yeah, but almost
Just the
50,000.
engineer's gonna be Monday
If you
night.
think about
It is, yeah.
it. I'm saying that was the VERIP year, was
Yeah.
fiscal year 22, so that.
Yeah.
You think that
We
the
had,
entire.
and then we had
watermark-
COVID too, like we had, I don't know if
Sure,
we,
we had to lay people off.
during COVID, I thought it was mostly part-time individuals. I don't know if they got unemployment or not, but with that,
It was also skewed because we were getting credits at that time too.
Okay.
There were different credits coming in. From
Yeah.
the state government, so that was kind of skewed
Okay.
number two.
all right, well, let's do, and a lot of these things are interrelated, obviously, because, you know, I mean, since we've been talking about the budget, as everyone knows, there's, you know, different puts and takes here, obviously, and I know you guys have been working on this, and, you know, I just want to make sure we have a good list of follow-ups for Monday. So we'll leave fund balance for that, for last on that note. Debt service should be quick. Do we want to just look at that one quickly? Page 221 of the book.
Sorry.
Page 221. So I know I asked this question in advance, but I just wanted to discuss it a little bit. And that's on the, you know, most of this is kind of baked in.
Yeah. It's just,
So the two assumptions in here are the 150,000, which is, you know, that's fine, cost to market bonds and bands, and then the 600,000, which is the estimated interest due. So this is, you know, we're going to issue bonds in July, and so we're estimating how much interest we're going to pay on new bonds in July. So that 600,000, can you just remind us the assumptions that were in there? Because I thought we were tracking low on bond issuances based on what we approved. So I was kind of surprised to see that jump there. And could you just remind us, what did you use, 32 million?
32 million.
And what have we approved? I mean, what are we actually like on track to issue in terms of bonds
Next year,
in July? Yeah.
right now, I would say, I mean, what we have on the capital plan, it's probably going to be in that range again. It's probably going to be around 30.
Is it? Why did I think we were at like 20 or something?
No.
That's the plan. We haven't voted on it.
No, we haven't voted on anywhere near that. That's why I was.
It might be in the plan, but I don't, yeah.
I mean, I thought that might have included the WPCA that's gonna, the phase 2, which would be like next year.
Well, that's actually going to be a proposal very soon.
Right, but we won't bond that in July
In April.
because I
No,
mean, we can't do phase 2 before we do phase 1, right?
so they're not necessarily, you know, characterizing them as phase 2, phase 1 isn't really.
They're not linear, okay.
Yeah, and they can happen simultaneously, so there would be some, it would start during FY '24, so there would be some kind of issuance for that. Not to be, well, it won't be the pro. My recollection is that I ideally, we would start it sometime around, between July and September, this quote unquote, the second part of it. And so there would be close to a year's worth of spending on that project. And the first one, the Wetlands Crossing, we're hoping to start that at some point, in this fiscal year. Start the project, start spending money.
So we had 32 million of, we have 32 million of,
So
yeah, I don't know why. I thought we were like at 18 or something like that, 20.
yeah, we're right at 32 million.
That number's, I'm surprised at that number too, but that's the number.
2.7.
Well,
There was,
Quickly,
so there was,
everyone understands, because there seems to be
there was
confusion here.
14 on the, in WPCA,
14 for phase 2.
total,
Okay.
14 total.
So 6, so there's another 8 million.
There's 7 town side, and the HVAC program is really gonna kick in.
It's gonna ramp.
There's 11.8 there.
Okay. And and we think that we're gonna be ready to bond all those WPCA projects this July. So these are gonna come before us for approval within the next 2 months or so?
Yes.
Second phase, okay.
Yep.
Okay. Well, we're getting some nice upside in our debt service numbers from these bond premiums, and these are 3-year straight line. Is that how we're doing these, if I remember?
Yeah, straight line, the schedule's in the.
Yeah, okay. All right. I mean, the rest of this is,
It's all from the debt service.
Yep.
schedule.
okay. All right. Any questions? All right. So fund balance is our next, I couldn't even find, is there a page for fund balance in the book? I know it's 0, but
It had been 0 yeah, it was.
two or 3 years. Okay. All right. So you gave us an analysis in the backup for a potential proposal on fund balance.
Yes. Yeah.
And that is, which is backup, do you know?
It's on page 16 of the PDF.
Oh.
16?
Sorry. We are.
It's page 14 on the hard copy.
Oh, yeah. So, yeah, and I'll wait for you to get there, wait for everybody to get there.
So before we get into this, I just want to refresh memory. So back in October, when we were allocating the fiscal 22 surplus, we set aside a piece that would wind up in fiscal 23, correct? It's like 750,000 or something?
I don't know that we actually,
We held it.
no, we didn't set it aside. It's kind of in that. It's part of that 8.4 million. I don't think we ever actually set it aside.
I'm just like, it says held for future use, requires it was 780,000. We marked that specifically. So I thought when we were trying to get to the right ending fund balance, we didn't want it all to go in.
Right.
20.
That was the plan, and then in part because of the new reporting requirement for leases, he ended up with as you well know, we ended up having more fall to fund balance than we had anticipated.
So this 780,000.
I'm not sure. What are you looking at?
Okay, I'll send it to you. It wasn't part of the 8.4. It was part of the proposed use of the spending surplus. And it was held in abeyance. And so I thought that was going to hit fund balance, but I just don't want to forget about that number when we talk about fund balance. Okay. All right.
So if you, let's start at, just go back a couple of years at FY21, where the amount the ratio was 11.34%.
Mhm.
And so our thought was to keep it at 11.34% this year and as well as last year. So with when the year closed, more money fell to fund balance. So the amount increased in 22 when we closed out 22 to 11.75%.
Mm-hmm.
All right, so that's where we're at now, just to kind of level set. Now let's go to 23. So in order to, if we were to not contribute anything to fund balance, your percentage would be 11.53%.
Based on what?
That's what your ratio would be. It's basically just from the increase in the budget. You know, you'd have the same amount in fund balance, but you'd have an increase in the budget, so your ratio would go down.
Oh, got it. Okay, and that's just based on budget. That's not surplus or anything.
That's right.
That's just
Nothing else going into it. So if you chose to do nothing,
right.
it would
Got
be
it.
at 11.53. If you wanted to hold it harmless, keep it at 11.75%, you would have to increase from 39,790, that first one in 23, to 40.465, which is an increase of 675,000. So
that's at the end of
at the
fiscal
end of
23.
Right, at the end of this year, you know, we're projecting a $5 million surplus at this point. If you chose to, you could take $675,000, put it toward fund balance, and you would keep it flat at 11.75%.
Okay.
What does our policy say? Harm or
Yeah.
let's do no harm.
Policy is-
We did no harm last year plus.
Yeah.
Well, through no fault of our own, we did plus, right? I mean,
Yeah.
and this year we could be in the same track. I mean, fund balance is looking like it's gonna.
Well, no,
No harm to FY21.
Yeah.
You want to do no harm. The question is, do you want to do no harm or do you want to increase the percentage? Because once you increase the percentage, you kind of don't want to take it down again, right?
Because then
Well, that's doing harm technically.
Right. But
If you level set it higher,
we
then you
didn't
go,
want
oh,
to
that's
do
good
harm.
harm.
We did good last year, right?
Yeah, no, I'm right.
Okay, so the idea is we
Just-
want
yeah.
to, so we want to get to 11.75%. Yeah, I want to revisit that 780 because I thought that's, what's that?
We have to add 675.
Yeah, but I thought we put away 780,000. So we're going to go back to the October and I want to understand where that money, it was part of the spending surplus. So I have the backup, which I'll send to you. It's in your schedule. But anyway, let's assume that we want to, I guess that the idea here is if we want to do no harm and stay at 11.75% at both 23 and 24, what do we have to do for 24?
So for 24, and I assume unless you're looking to go back to the sort of the old practice of appropriating money to fund balance, this would be what you would do at the end of 24. So at the end of next fiscal year, now you're up to 3 options. You could do, if you did nothing in 23, and again do nothing in 24, then your ratio drops down to 11.22%. If you just put in the 675,000, then it goes by 24. Yeah, so it would. It's not going to matter.
Okay.
No, I shouldn't say that.
Can I just?
If you put it in 24, then it would go to 11.41%.
Can I just ask how this board feels? Does the board feel, or maybe just, does everyone feel that we should stay at 11.75%?
Before you take a census.
Okay.
I did talk to Matt Sperndel about this, and I explained to him the whole situation and what the plan was and how things worked out. I said, you know what, and I gave him kind of the range of the ratios that we're talking about here. You know, his feeling was it's not going to matter.
Not going to matter.
Just in terms of our credit rating and how the credit rating agencies would view us. These changes are pretty small.
Okay.
Keeping it above 10%.
That's
Yeah, and because I always, that's why I hated to see it up bump up to 11.75, Frank, because I feel like once it goes in, you don't want to take it out. But I mean, does the board?
Let it bleed down a little bit, I think is what you're saying. But can I ask one
Yeah.
clarifying question? Just, I think you were almost done with your numbers, but not quite.
Yeah.
I just want to get to that fourth note. If you
Yes.
did want to stay 11.75 after, right? Are you saying that it needs 675 at the end of this year and 1.2? So it's 1.8
Yeah.
total?
It's 1.9, yeah.
Yeah,
1.9.
okay.
Okay.
I just want to understand the magnitude.
So if you were to put in the 675 into, let's say you did it on an annual basis, you put in the 675 in 23, that keeps you there.
Yep.
In order to stay there at the end of 24,
Yep.
you would have to put in another 1.225.
And historically, we've always budgeted that. It's always, we've budgeted
Yes.
surplus to do
Right.
that. Yep.
Right.
Yep.
But if we do nothing in fiscal 23 and we do nothing in fiscal 24, we'll end up at 11.22.
That's right.
So technically we're doing harm, but I mean, in reality, we're not.
Shouldn't
harm, right?
shouldn't the number be, we want to keep it at 11.34% because that was our intent last year, wasn't it?
Doesn't matter what our intent was. It is what it is, right? So.
The stated policy, according to the purpose, to keep it between 7.25 and 11.
Correct.
Yeah. Or we're above that. So, anyway, I don't care.
I don't know. Anybody, you have a view?
So,
I will tell you that I see nothing to say that we shouldn't be closer to 15, to be quite honest with you. I've not seen anything change, especially in a community that potentially could be, hit by a hurricane like Storm Sandy. So, I mean, our body needs to, our board, our subcommittee needs to meet, talk about it. But, my thought is we're looking at a $5 million surplus this year. Looking at more positive money coming in next year. Hard pressed to see why we should be reducing it when we are already looking at next year for the following year, a huge increase on the Board of Ed contract. Huge, like catastrophic huge. So if there's going to be a year to talk about reducing, it would be in that following year. So I'd be careful about that because there's going to be so many stresses with that Board of Ed contracts based on the settlements we've heard that are coming in on some of these contracts, that I'd be really careful of taking advantage and start lowering this thing because, if we need to not fund it again the following year, we're going to be going down, down, down. And at some point, the credit agency will be like, hey, wait a minute, and I'll be going to Matt Birdsdale saying, hey, Matt, you said it wasn't going to be a big deal. Now, all of a sudden, after 3 years, it's a goddamn big deal. And why did you recommend doing that?
Yeah, I agree.
I mean, 675 out of 5. Number one, I'd like to find out the number that you talked about, whether we had said to put more money in.
That's for fiscal 23.
I know, but I mean, it'd still be more money.
That means if we have surplus in fiscal 23, we can, yeah.
Well, that's,
And Mary, what?
so that's exactly what I think we should do, is not budget for it now, but we know we have a surplus coming. Plan to carve out that first 675, add it back to the.
And
But that's for fiscal 23 though. What about fiscal 24?
So I'm hoping maybe we can keep the surplus going. I've got.
Here's the thing.
It's earning interest. Yeah.
No, and I think it's like 6 of one, half dozen of the other. If you have the surplus, then you have to commit your surplus, part of your surplus to fund balance.
Yeah.
So
Right.
here's what maybe it's not a rare occasion that we agree. I kind of, here's my concern. And hopefully we continue to have surpluses. But we have a lot of other things we could do with surpluses too. I feel like this board before my time was always very disciplined about budgeting surplus to fund balance to keep it consistent. And it was part of the budget every year. And then the pandemic happened. And we stopped one year and we never did it again. And once you take it out, it's really, really hard to put it back because
Big
then you
number.
have to deal with it.
Big number, right?
And once it's not in the operating budget and you kind of get on this drug and we're relying on surpluses, like that doesn't always materialize. And, you know, honestly, for me, you know, I'm not interested in, you know, taking a hit to the mill rate to do this, but, you know, if we have upside in other areas, I don't think it would be a bad idea to start, and I'd like to see all the areas, because frankly, I'd like to have an updated conversation on conveyance tax. You know, I think we're gonna have things that offset interest income, but I just think that, you know, to Jim's point, you know, you could creep down and down and down, and, you know, listen, if we have surpluses, wouldn't it be nice to put those away for, you know, if we're done with Penfield after this mess, and we're done with the 40 sites in July, I think Tom Bremer said, we're still facing whatever awaits us at the WPCA and the aggregate fill pile, all that stuff out there.
Right, yeah.
And, you know, to be able to devote surpluses to that and get back in the discipline of budgeting for fund balance might not be a bad idea. That would be my.
Yeah.
So- I know I was on the original fund balance committee. I'm no longer on, but I would like to be again someday.
Join them. We did call a meeting.
But anyway, at that time, we were trying to get the town on board, and we knew it was going to be hard to convince all the different boards. And so we went with a conservative number for that policy, just so we could get buy-in from everyone. We knew that if you look at all the evidence out there and documents and what other towns are doing, the end of the range is like 15%. So we had, you know, a very conservative goal to get it, to start working our way up. And we did it quicker than we thought, which was wonderful. But I still kind of always have in the back of my head that 15 is really where someday it would be nice to be if we could, you know, gradually get there. But I think that's something the Fund Balance Committee really has to take a look at and update all that documentation.
Chris?
I'm between Mr. Mottola and Mr. Walsh, right? With Mr. Mottola's point about shouldn't we stay around 11.34, and Mr. Walsh saying we should get, you stay at, you know, potentially go 11.75. If we do the 675 in this fiscal year, and then don't budget in the budget we're talking about right now, we'll be at 11.41. We're higher than 3.4. We're doing no harm, and we're increasing, much to Mr. Walsh's point. But I think this board has to have a little rigor around updating this policy. Because listen, I'm a policy guy. You know, everybody knows this from the years of me, you know, complaining about policies. Our policy clearly says, here's the range, right? Now, I'm not saying that that's the right range, right?
Yeah.
But we have to have a little rigor around locking that number down. Then the next board's decision to do this will be like, well, it's to 15. Let's go. We got to go to 12. Forget 11.75, right?
Yeah, and we were in the bottom 50% of the AAAs in Connecticut, as I recall.
We were. I thought we were in the fat part of the curve, middle, but yeah.
I thought,
Get that number.
yeah,
Yeah, that's probably a good chart to get refreshed.
we're on the low end.
Or low end, like.
We're on the low end. For
And
AAAs.
I'm not saying, and I've always said this, I'm not looking to be the
top.
No.
No, we're being the top either, right?
And other towns that are like at like 18%,
Yeah, no.
19%.
Yeah.
I'm not looking to do that, but I'd like to be closer to the middle.
Yeah.
Not just be at the bottom.
I just feel like having it in the budget it gets us back to the discipline we always had. And then,
Oh, you
and
balance.
it's, again, so then you have less surplus, but you could put your surplus toward, you know, mediation or whatever you want, instead of you have surplus, but you can't, you know,
Yeah.
it goes either way. But I think, again, once it's out of the budget, it just never goes back in, so.
I just have a question. We got from 11.34 to 11.75. I don't want to say by accident, but it was not intended, right? And I think the general consensus that I'm hearing is that we expect to have a surplus this year. it's good to know that thanks for calculating the 675, Jared. It's good to know that we can take some of that projected $5 million surplus, put it towards fund balance and maintain the 1175. I guess my question is, do we know exactly why we went from 1134 to 1175 unintentionally? I understand process change or whatever happened, but I don't mind going to 12 or 12 and a half if that's what the sport
Short
wants.
story, the audit got done late. That was it.
I don't want to get to 12.
You don't mind going to 12 of this by accident?
Right.
I get, yeah, that's,
It was a new GASB they put in place that we had not worked up projections for, I believe. And so until the audit was completed, they didn't have those new lease numbers.
So do we have confidence that it'll come in earlier this year?
Well, we had that was the subject of the last audit committee meeting.
Yeah, we're gonna make sure, I think December 1st was the target date to have a draft audit, right, Mary?
Yeah.
Our last meeting, so we'll have it.
This year. So we're not going to go to 12 by accident then.
unless Gatsby changes something else.
Yeah, fair enough.
But that's a fair point.
Right.
So
That's fine.
I think that, at least for me, the way I was thinking about this, and I know that Jared and Frank have been working hard on this too. Obviously, new information comes to light during a budget process. And we have things going in lots of different directions here. And, it would be good to see what those tally up to. It seems like there's some, desire to, because what I said about fund balance, once it comes out, it doesn't go back in the, you could say something about risk management, right? So, and I know that was your concern last year. Doesn't mean, doesn't make me think we should have a $6 million fund balance, but I get that,
It's a rigor.
keep it at zero forever, right?
Yeah.
Just like we're not going to have money in the special police fund to buy police cars forever. Like at some point, these things are going to come back and they're going to hit the general fund budget, right? So to the extent that we can, clean some of that geography up this year, I think that's good. And Monday night, I think it would be good to kind of have these things laid out. I just want to make sure though that we all understand what the pieces are. So I think the big ones, right, were, so we talked about interest income, there's insurance, there's pension and OPEB, those numbers have changed. There's risk management, there's fund balance. There's maybe some small things like unemployment, right? There's some small things like Social Security, if I recall.
The operations.
Yeah, like
We have to
opening
add that.
Penfield, opening Burr Mansion, those things. I feel like if we, if we had all these things added up, and they added up to $1 million credit or something and allowed us to put that money into fund balance, I would feel pretty good about that personally.
It's good to have the numbers in.
And we'll get updated insurance numbers
Yeah,
The updated, right?
on Monday.
yeah, we will.
So just.
Oh, and conveyance tax was the other one. I know Betsy, kind of stuck to her guns, but I just don't think there's any good news coming in the real estate market, like anytime soon. So I really, that one I wonder about. So that's a little bit of an offset. So, I just wonder how you guys feel about that too. So,
And just so we're clear, there's, right now in our budget book, there's nothing in here. There's no
fund balance, no.
fund balance, right? And did the Board of Selectmen have a discussion about fund balance? I watched
Nothing in depth.
nothing like we're talking about here, right?
So this is stuff no one else cares about.
Well, I could tell you, Mr. Flynn cares about it.
Oh, I think it's true.
So, yeah. In general terms, I get it, that board, but, I'm just curious. Okay. Listen,
We're Monday night too.
these are the numbers.
What's that?
So that's
Monday night, we had requested, or like I requested, that whether the Board of Ed was going to have a meeting regarding that.
The non-lapsing.
On the list, yeah. You wanted to take a sense of the body on carrying over the 350.
So I called Nick Asa yesterday
Mm-hmm.
to see whether that happened. hasn't happened. And it hasn't been scheduled, so it's been basically by the Board of Education.
Okay.
I told Nick I was disappointed that that's the way they handled it, because the last time that they wanted to have a non-lapsing account for 2 million dollars.
Yeah,
This body jumped on it,
yeah, that's pretty special.
participated with them and cooperated with them and made it happen.
So your point is, you know, we wanted to have a sense of the body before we voted, but
Yes.
we don't know what the Board of Ed wants.
Yes,
I think
because
we know what they
it's-
want, they just haven't formalized it, right?
Yeah, but I will say, just for thought, I would like everybody to think about it before. And I'll take the input of the administration as well. But the more I thought about it, the 350,000, that's what it is? The grant that they're gonna get is gonna be made out to the town of Fairfield. We fully funded their budget last year. That included, because that's monies for this year's stuff. The grants for this year is for the amounts they expended on COVID materials.
Well, for 2 years ago or whatever it was, but yeah, they got the money.
We fully funded it.
They're getting in this fiscal.
They got the taxpayers' dollars,
Mhm.
every penny of it, including a surplus that they spent this year of $2 million.
Mhm.
If that money's coming back to the town, why exactly would we ever turn it over to the Board of Ed when they got fully funded? So we funded them.
Well, it's for
We
next
gave
year.
them, we gave them the cash.
It's for next year though, right?
But no, we'd have to do a lapsing account to do that.
Right.
And they're saying it's gonna come in this year because they would like to, what I heard from the chairwoman.
I
Jacobson.
thought they were asking for a non-lapsing account to put them.
They want it for other things that they.
No.
For next fiscal year, right?
No. So we asked whether they would consider moving it into a non-lapsing account,
Yeah.
and they've decided not to act. So my thought is that.
Maybe they just haven't acted yet.
Aren't
We
we
should
like-
follow.
The town has to agree to give the
The
money.
town
to
did
them.
agree.
They
I
did, the
think.
Brett, the
Yeah.
first selectwoman agreed to do that, right?
Yeah.
Okay.
But here's the deal. I don't want the money to be given to them this year and them to spend it more money. They've already
No.
had $2 million extra.
No.
last year.
I don't
Paid
think,
extra
yeah.
for us.
No.
What
So-
the first selectwoman said was, I think, getting at where you're going was that 350 could be used to
Next year, offset.
offset the.
Right.
Right.
But they haven't agreed to that. Or they haven't had a vote on it.
I
And
think they want.
okay.
Well, I get, so
My thought
here's
is
the
that the
thing.
money should stay in the town's account and we should hear from the first selectwoman until we work that out.
Yeah, I mean, I think you said you wanted to have a sense of the body before we voted on this budget, which is not gonna happen if we don't know. So they need to speak
Yeah.
and tell us what, and I think they sort of told us, but I think we had representatives from the Board of Ed, but I don't know that they were speaking on behalf of the Board of Ed, right?
Can we have Ms. Jacobson at Monday's meeting?
Sure, but she's gonna be speaking on her own behalf and not on the board's.
She'll tell us what's going on.
right.
We'd asked her to
Yep.
schedule something.
Okay, that's
Is there
fine.
any follow-up for the Board of Ed on Monday?
I don't think so.
No.
All right, was there anything else? So, and I'll connect with you guys just to make sure we have but is there anything else that anybody, because Monday, first of all, I want to thank you guys again for the Google Sheet. All that stuff, if that was on email, that would have been horrible. It would be great to have it in one place, so thank you so much.
Yeah.
Quality, organization, so much better. I just want to make sure we're not missing anything Monday that people wanted to, so I just rattled off a quick list of things. Was there anything else anybody wanted to follow up on Monday? We talked about,
I know it's in our backup, but maybe.
I'm going to read the backup. I've
Yeah,
had a chance to read all the contract, and I might still speak to Mr. Biganet. We can talk about it.
okay.
Yeah, that's a good idea.
Just, it would be helpful if we, just to get the agenda together and to make sure we can have anybody we need, if you guys could just please, let us know.
Yeah, if we think of something.
Yeah.
What ball thing we talking about? We talking about this cart?
And,
Oh, really? Okay.
Hopefully we can do that.
His contract's in the back.
Yeah, it's.
Backup, I mean, it's,
Yeah, and I mean.
I wouldn't waste 5 minutes on it.
There's nothing to say that we can't have conversations offline if we want
Yeah.
verification. We've got all the data there. The idea Monday is things that we actually have to talk about. And so there's a few big things here in my mind. So,
Good night, everybody.
what?
Where is the
I'll ask Jen Jacobson. Okay, all right, so,
We want to talk about contingency.
oh, that's right.
We're gonna go into private executive session, right? Anyway.
No, I don't know if we have to on that or not. Because,
We got that for the workers' comp though.
well,
Not
I
workers'
think
comp.
we,
what was
I
it?
think we do for the, to talk about fire, because we gotta talk about that base year and what's included.
okay, because I thought that, the town's offer was public at this point.
The town's offer is, but when we start talking about, all right, how much has been set aside, then we're going into what's been put into.
Okay.
Yeah, I guess contingency measure.
Yes.
We haven't fully talked through that, right?
No, that's
Monday.
That's the point, yeah.
That's gonna be a long night.
Yeah. It's already almost midnight, so.
I'm going to be remote, so I'm just saying, feel free to be remote if you want. All right, can I have a motion to adjourn?
Motion.
Stark, Early. Thank you, guys.
Good meeting.
Hey, Jared,
Good discussion.
I'm going to send you.